The market does believe, as the Fed talked about yesterday, that we are approaching the trough of economic growth.
Now it's don't fight the Fed and don't fight the AI trade.
I'm not convinced that anybody's ready to give up on U.S. technology outperformance.
In stock markets and companies, the truth is, if you're not growing, you're not going to be around for long.
You don't want to be underweight equities right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday at record highs, all major benchmarks hitting fresh records for the first time since 21. As President Trump is gearing up for a phone call with President Xi, FedEx is working to shake off a $1 billion hit from this year's big shift in trade policy.
So this is the big irony, and you set it up perfectly, this idea of record highs, and yet we're still dealing with this massive shift in trade policy that still has uncertainty that might get sort of resolved in some capacity when we get this phone call between Xi and Trump. How much are companies able to brush it off? FedEx, you mentioned, still managing to beat expectations on Wall Street, even with a $1 billion hit related to China trade, as well as just generally extra costs.
We've moved on. Reinstated guidance, looking for growth. Mid-single digits, I know, but we've moved on. Equities, record highs. We talked a lot about credit spreads, investment grade, multi-decade tights. High yield, near the tights of the year. This market has moved on.
And how much is this something that's healthy, and how much is this developing into a bubble, and does it really matter? And I think that this is sort of the existential angst heading into the weekend. The idea if it's a bubble, maybe you want to buy in even more, because bubbles can last a lot longer than people can doubt them. So there's this question of, as you see people rush into stocks, you see a complete flood out of cash, you see a flood out of bonds, you feel everyone just saying, don't fight the Fed, don't fight policy, don't fight the U.S. consumer that keeps on spending and keeps on spending a lot.
But respect the process. Mike and Morgan Stanley this morning. Downside risk to the economy should remain elevated, while the corporate sector tries to pass higher tariffs on to consumers. Goes on to say this process has only just begun.
So here's the ultimate question, and I think that the Fed really addressed that this week. How much will the Fed underwrite any potential weakness that comes on the heels of some of these tariffs? And the idea that we're seeing these tariffs and we're seeing companies adapt and adjust like FedEx, and you're still seeing consumers buy, you're still seeing consumers spend, and they've been able to absorb it. So can we write off that weakness? I think that this is sort of the tension right now, because you've never seen a loosening cycle, an easing cycle like what we have seen since last September, 125 basis points of rate cuts by the Federal Reserve without a recession. Since the 1980s, we have not seen this level of cuts. And so now we're suddenly seeing stocks race to record highs because they are embracing the idea we are not going to see weakness that has not come through yet.
And let's be clear, the Fed's not done. They're indicating there's more to come. And this meeting was important. Why? Because the other forecasts suggested this economy will be okay. In fact, they cut interest rates and revised the outlook for growth higher, not down. They revised it up.
So here is the other issue that I think markets are dealing with. It sort of tacitly allows inflation to run hotter. And in that type of environment, stocks can keep on doing well as long as consumers can absorb it. The real tell will be the Christmas shopping season and whether consumers will absorb some of the higher prices, as we've heard from retailers, or whether they'll push back. And that ultimately will really decide how much inflation can run a little bit hotter and how much that really could affect the bond market, which people are pulling back from in any case.
If it's good for stocks, is it really good for bonds? Yields this morning higher by a basis point across the curve, 10s at 412. Coming up this hour, we'll catch up with Geoffrey Yu of BNY with record highs across Wall Street, Ed Mills of Raymond James ahead of President Trump's call with China's Xi Jinping, and Pierre Ferragu of New Street Research on Nvidia's big bet on Intel. We begin this hour with all four major benchmarks closing at new records for the first time since November 2021. Investors diving into risk with Fed interest rate cuts on the way. Geoffrey Yu of BNY writing the following: we remain of the view that rate differentials for the Fed versus major peers have reached their point of maximum pricing for this year. Jeff joins us now for more. Jeff, welcome back to the program, sir. Let's build on that line there on interest rates. Push that through foreign exchange. What does it mean for the US dollar?
Well, for the US dollar, I do think that a lot of the hedging that allegedly has been put on over the last few weeks, and you've got to unwind that. We're looking at, even with what's priced right now, the US enjoying perhaps good rate differentials, versus most of its peers. I'm looking at dollar yen, for example, but also versus rest of APAC, dollar Taiwan, dollar renminbi, dollar won. So I think all of that's in play for the international investors who are looking at the stock indices and now look in the US and saying, maybe in terms of earnings translation, I'm in overweight US because the dollar has cheapened quite a bit this year. Now I want my total return to come more from the exchange rate side as much as the stock side.
Jeff, which asset class is in the driving seat at the moment, and what's the relationship between risk, say equities, and foreign exchange?
Well, I would say still those allocations in the US exceptionalism, how much of your returns distribution do you want from the indices and how much do you want from the dollars, from the exchange rate? I do think that's going to pass on more to the exchange rate at this point. And also in terms of the treasury market, if you look at the data, if you look at our flow numbers, for example, I would say the US, it's still doing quite well. Yes, cross-border flows have softened a bit, but again, for this year, there's no sign of that mass liquidation that people were talking about in the second quarter.
Jeff, what you're saying is pretty radical, considering that the consensus trade is that the dollar is going to weaken, and some people have speculated that the pain trade for the remainder of this year would be a strengthening dollar, which is essentially what you're betting will happen. What do you think that will disrupt the most in the market if we do get some kind of significant dollar strengthening?
Well, I think markets would actually welcome that as a bit of an adjustment in terms of where the US is in terms of relative growth. But I would just want to pick up on something you said about the Christmas shopping season. I think Governor Ueda of the BOJ actually mentioned that during his press conference today, saying he's now looking at the export orders for Japanese companies to get a gauge of how the US the US holiday shopping season is geared towards. So I think that's where you're going to see foreign central banks look at the external circumstances and whereby can the US maintain its current trajectory. If it can, then I do think that the dollar will benefit.
So just build on that, Jeff, because this actually is really interesting. How much is the global economy and global central bank policy hinging on how much the US can consume or can keep on spending and keep absorbing any kind of cost increases?
Well, put it this way, I think they are depending on it more than they're letting on at this point. So, yes, if you look at APAC sales to the US, exports to the US, that has come off, but it hasn't been a structural break in the relationship. If I look at ahead of today's phone call, for example, between the two presidents, it seems like this rolling 3-month agreement, that seems to be the new normal, the new equilibrium. And you're seeing the exporters in APAC who are very nimble. They are adjusting to that. So, again, there isn't this structural break that we're seeing. They still are dependent on it. It may not be right, but that dependency is still there.
So, Jeff, we started out the show talking about this tension between all of the indexes in the U.S. at record highs for the first time since 2021. The Russell 2000 are really the one creating that benchmark. And at the same time, we're seeing this ongoing discussion between China and the U.S., as you were mentioning, about tariffs. It still isn't a settled, done deal. Is that a tension at this point, or have we resolved the trade story? Is there still not a lot of tail risk that can come from some sort of reacceleration in some of the tensions?
So I think the higher risk has been priced. So we all follow the Yale Budget Lab, what the average level of tariffs is compared to before the new administration. So that already is baked into the price. So in terms of the new shock to the market, are there expectations of additional tariffs or a reversion to maybe what we saw in early April, for example? I don't think that is coming back into the price. And we would broadly agree with that view. I think it's in everyone's interest right now to maintain this new status quo, so to speak. But as mentioned at the top of the hour, so whether consumers, especially in the US spenders, can they continue to absorb that? And also, globally, you're seeing, trade tensions, rise as well. I look at the retail sales numbers released in the UK, for example, this morning. As much as we're talking down the UK economy, they're still pretty robust. So consumers globally, they still are spending. And now, is there going to be a pivot on part of APAC consumers where there has been more disinflation? China's trying to drive up CPI, for example. Are we actually going to get an upside lift there? I think that's going to be one of the talking points for the rest of the year. Is stimulus coming out of Asia?
Yeah, let's stay on that. Are you seeing signs that they're willing to cut overcapacity in China? Are you seeing any of that at all?
So the messaging from Beijing has been very clear, a change in mindset in industrial policy, a change in how corporates behave, this cutthroat competition. I think that is very clear right now. I think now we're in the implementation phase. Can the corporates actually adjust their behavior accordingly? I think the proof will be in the earnings results. But if you look at what's driving the sectors being driven in terms of Chinese equities right now, it's actually the tech story as well. It's the structural growth story rather than the consumer side of things. So I think now that's where reality, versus what the policy statements are saying, we need a bit of conversion.
Well, this is it, Jeff. We've been talking about this for years. So they would cut back on the overcapacity, that they would do something about boosting consumption. Jeff, I've seen that and heard it a million times, and then it doesn't materialise. Is that actually going to come together next year?
So I would say the rhetoric has been far, far stronger compared to any previous attempt. So two things I'm watching for. One, of course, the corporate earnings and also the PPI, the export prices from Chinese companies. But also what we're seeing right now, and is this a debasement story for fiat money in general? Is it a terms of trade story driven by China? Commodity prices and also the companies, the holdings of companies, the miners associated with commodities, that is rising. So what we're seeing in equity flows right now is growth is being priced in from somewhere. And given where US valuations are, I do think that a pickup in China and leading Asia along the way, I think that is coming through. A key part of that is APAC currency strengthening, a stronger renminbi, greater tolerance of that. If that increases purchasing power on the part of Chinese and broader APAC consumers, that can only be a good thing for the global economy.
Jeff, thank you, sir. Appreciate it. Jeff Yu of BNY, and that cyclical tilt starting to emerge elsewhere out of Asia.
The idea here is he was talking all about reacceleration. He was talking about the gauge of how much the reacceleration could really take on steam. And we're talking globally. Again, no one's talking about weakness. You mentioned, is there going to be this weakness from some of the higher prices and consumers pushing back? No one is talking about that in any capacity this whole week, and I think that is the big takeaway.
You mentioned the Bank of Japan as well. Did you see the headline from this morning about normalising the balance sheet a little bit?
Okay.
ETF rollout.
Yes.
Sales plan. It's going to take 100 years. 100 years to sell off that position that they built up.
Okay, you picked up on exactly the right point. On one hand, normalizing the balance sheet. Oh, my goodness, they have $500 billion of ETFs in their balance sheet. They own about 3/4 of the market or something like that. I'll get the exact statistic coming up. But they're just allowing a nominal amount to roll off every year. This was what we heard from Governor Ueda at the conference. We won't be here in 100 years' time, but our intention is to keep selling for more than 100 years. So, it's definitely a notable move. I don't know that it's going to break the bank, so to speak.
If in doubt, make it someone else's problem.
Exactly.
Equity futures this morning unchanged on the S&P 500. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yohara Anand. Hey, Yohara.
Hi, John. Sticking with the Bank of Japan, it kept interest rates unchanged at 0.5%, but took a step, as you said, toward policy normalization. The BOJ announcing it would start to offload its $508 billion stockpile of ETFs. It marks the first time the BOJ has laid out a plan for offloading the assets accumulated over years of ultra-easy monetary policy. And as you said, it's going to take 100 years. Meanwhile, in the United States, President Donald Trump is gearing up for a phone call with Chinese President Xi Jinping. The two are set to speak at 9 a.m. Eastern. On the agenda, the fate of TikTok and potentially easing trade tensions between the world's biggest economies. The call may lead to an in-person meeting between the two before the end of the year. And FedEx shares are rising 5.25% in the pre-market after it beat on both the top and bottom lines in the first quarter, and it reinstated its outlook, that overshadowing a warning from FedEx that it expects a $1 billion hit from trade volatility. Most of that comes from reduced shipments from China to the U.S. That's your Bloomberg Brief. John?
Stock is up 5%. Yohara, thank you. Appreciate it. More from Yohara later this hour. Up next on the program, direct talks with China.
I'm speaking with President Xi, as you know, having to do with TikTok and also trade, and we're very close to deals on all of it. It sounds like they've approved TikTok, and TikTok is a tremendous amount of money for the United States.
Up next, Ed Mills of Raymond James, live from New York City this morning. Good morning. Bouncing back from a two-day losing streak in yesterday's session, a really nice day of gains, heading towards a third consecutive weekly advance for the S&P and the Nasdaq For the Russell, we're looking at a 7-week run, the longest going back almost 5 years.
So how much is this a catch-up and how much does this have legs? A lot of people saying that the idea of rotating into the other 493 definitely has legs. The idea that the Russell 2000 is emblematic of the rest of the universe, given that it's a $3 trillion market cap, less than NVIDIA, maybe less so, but still something very notable to watch.
We've traded off the rate story. Now show me the growth.
Yes.
Show me some real growth going into 26. Equity futures this morning, just about unchanged. Under surveillance this morning, direct talks with China.
I'm speaking with President Xi, as you know, having to do with TikTok and also trade, and we're very close to deals on all of it. And my relationship with China is very good. You know, we have a trade deal with them. We had a very good meeting the other day, and it sounds like they've approved TikTok, and TikTok is a tremendous amount of money for the United States, so that was nice.
So here's the latest this morning. President Trump and China's leader Xi Jinping are speaking at 9 a.m. Eastern Time. The leaders expected to talk trade, tech, and a deal to keep TikTok in the United States. With the latest, here's Bloomberg's Tyler Kendall. Good morning, Tyler.
Hey, John. Good morning. Well, you said it. We're expecting the main focus of this conversation to be around the framework agreement for TikTok. We're still awaiting a lot of details, but people familiar tell us that a potential deal will be structured with a group of outside U.S. investors, including Oracle, existing U.S. investors, and then ByteDance will hold a less than 20% stake in the company, all part of a bid to try to satisfy Congress's national security law. So no doubt tech is going to be at the center of the conversations today. That goes for NVIDIA as well, as the company has repeatedly found itself at the center of these trade negotiations. But at this point, it really feels like TikTok might be the most tangible development that we get out of this call, because while it appears the broader trade talks are on track, we heard President Trump yesterday tell reporters that he is considering extending that tariff truce that's set to expire on November 10th. This call is really widely seen as a way to lay the groundwork for a potential face-to-face meeting between the two leaders. It appears they're eyeing a potential meeting next month at the APEC summit in South Korea. And that is when we are really expecting to see perhaps more developments when it comes to how the trade talks are progressing. And that includes on market access for U.S. products. And John, I bring that up because new data analyzed by Bloomberg News show that China has not placed any orders for U.S. soybeans so far this export season. And it's leading our analysts at Bloomberg Economics to say that this really underscores how the clock is ticking to see perhaps some more development, some more movement when it comes to addressing U.S. concerns in these trade talks.
Tyler, thank you. We showed some pictures there of President Xi Jinping, and he had two flags behind him. One was the Chinese flag. The other was the Brazilian flag. If you want to know where these soybeans are coming from, that's exactly where they're coming from and going into China.
And we've seen a strategic move by China, particularly into Latin America, South America, and trying to secure a lot of raw goods, raw materials on a whole host of fronts in order to immunize themselves from the United States.
And it's hurt American farmers. And that's going to become a bigger and bigger piece of the conversation here domestically when we talk about these trade issues. Joining us now is Ed Mills of Raymond James. Ed, welcome to the programme, sir. Let's start with TikTok. How are you thinking about TikTok? Is it its own individual story, or is it part of a broader trade negotiation?
Well, I think, John, if I look at the law, TikTok should not be operating here in the United States, but for the fact that the president has extended this through executive order. And there's a lot of conversation here in D.C. whether or not he had that authority. The big issue is who is going to sue on that. And then when we look at this deal, one of the big questions has been whether or not the algorithm is going to continue to be controlled by ByteDance, which is a Chinese company. I went through the law, John, and it does say that a qualified divestiture, there's 2 paragraphs, and the first words of each paragraph is the president determined, the president determined. So we're going to have a lot of conversations in D.C. whether or not the spirit of the law is followed, the letter of the law is followed. But ultimately, kind of Congress did give a certain level of deference to President Trump. He's going to use that deference to cut a deal. I think he does want TikTok to continue. He does want that for his base, especially as we go into the midterm elections. And then we work on all of the other things as part of setting the table for that in-person meeting between Trump and Xi.
So that's where I wanted to pick up, Ed. We've been wondering, is this all about TikTok, or is there a broader range to some of these discussions? And I'm just wondering if what I'm hearing from you is this really is about TikTok. And as long as they can get some sort of agreement, then they can begin to talk about the other issues. Am I getting that correctly?
Yeah, so when I talk to my diplomatic sources, people who have dealt with kind of these type of negotiations, what they always talk about is, can we get some confidence building exercises before we move to the next step? I also have heard from them that President Xi very much likes to go into face-to-face meetings with 98, 99% of things settled. So getting something that's very contentious settled, and we've had this kind of extension through December 16th, and that getting kind of that process going. And then if we can have a delay of those November 10th deadlines for the next trade kind of a deadline with China, those are things that can build that confidence for them to sit down. And I'm also looking for the Trump administration to use that deadline and the fact that a lot of these are IEEPA-based fentanyl tariffs. We have a November 5th deadline now with the Supreme Court holding oral arguments on whether or not those are constitutional. The administration trying to use this meeting as a bit of theatrics of don't undermine me as I'm still negotiating with our largest kind of competitor on the world economy, the number 2 economy in the world, Lisa.
So everyone's been talking about this as though we're not really going anywhere. We're kind of just 3 months. And this reminds me of an American football pile-on where it looks like they're just sort of lying on each other, but under the hood, there's a lot going on to try to jostle for the ball. How much is the ball continuing to move when it's about the antitrust suit against Google that China put on and then took off? I mean, all of these sort of attempts to gain leverage. How much is there that escalation risk in order to get an upper hand on the bottom of that pile-on?
Yeah, Lisa, I think that's a really important point because what we've seen is China's been exceptionally different in Trump 2.0 than they were in Trump 1.0. They have been much more aggressive. You mentioned that kind of antitrust suit against Google. That's off. One of the things that Trump tried to do is escalate and then say, I'm de-escalating and giving you something. But China, when it came to the H20 chips with NVIDIA, some of the AMD chips, they're like, this is something that we already had. And you took away from us temporarily, now we're not necessarily going to buy them from you. What else can we do? We see the deal yesterday of NVIDIA investing in Intel, and that brings up questions. Are there more opportunities to expand on kind of some of the relief that China gets? Because that's what China really wants. They don't want the tech restrictions that they've had over the last couple of years. They want access to some of the chips that had been previously banned, not the chips that were banned temporarily almost for theatrical reasons. I think that's going to be the real part of these conversations that are going to be very difficult, and it's really going to kind of really test Trump with his congressional base, whether or not Republicans allow him to do that in any of these talks, or do they push back and put in law that he's not allowed to give these chips to China?
I know a man called Jensen who would like that to happen too. Are you suggesting that maybe the top-end chips coming from NVIDIA, maybe they might get what they want? They might be able to sell them into China?
I am skeptical, but I am sure this is going to be part of the deal. And especially when things become transactional. When you look at the TikTok deal, what does President Trump lead with? This is going to be a lot of money for the United States. Whether or not it complies with the explicit instruction of Congress is almost secondary. We've seen with the investments that President Trump has wanted, the fact that NVIDIA is investing a lot in the United States, that gets him on his good side. The fact that they're investing in Intel, that he took a stake in, that gets him on his good side. The more they push, the more likely this moves up to the top of the conversation. And I wouldn't put it past them to be able to get some level of relief, even if it is just not as strict kind of harmonization globally of some of the semi-cap equipment that is currently restricted from the United States going into China. But maybe it's not as restricted coming in from Japan. Maybe it's not as restricted coming in from the Netherlands. That would be a big win for China that they would absolutely love. It might not be the kind of specific chip from NVIDIA, but there's a lot of other nuances to those restrictions that they would love to take.
Interesting. Ed, thank you. Lots to think about. Appreciate it. Ed Mills there of Raymond James following that blockbuster investment from NVIDIA into Intel is a question we asked yesterday. Does that get NVIDIA and Jensen what he ultimately wants, which is the ability to sell some of these high-end chips into China?
He wants it. China wants it. Maybe it could be a good negotiation tool. What does the U.S. get on the other side? This is such a complicated kind of negotiation, especially because I don't have a good sense of what the ultimate goals are. what the parameters are, what people want the U.S.-China relationship to actually look like.
It's a new era of statecraft coming together in real time. Nvidia down in the pre-market by about 0.2%. Up next on the program, Marissa Adams of HSBC as FedEx delivers a warning on tariffs and trade. Plus, Yahira has your morning movers. Intel down this morning, just a touch, following the biggest one-day move since the 1980s. "60 minutes from now, don't miss this conversation. Jim Bullard, the former St. Louis Fed president, joining us on the program in the studio following his conversation with the Treasury Secretary Scott Bessent to fill a seat vacated by Chairman Powell early next year.
Very curious to see what the parameters are for the discussion for a potential future Fed chair. What is on the table? Not that he's going to necessarily disclose all of that, but I want to understand how different the mentality could be of the FOMC next year with very different leadership.
If you had a dot plot, where would you put your dot? How low would it be? And Jim Bullard could turn around and say, well, last time I was at the Federal Reserve, this is where I put my dot. And his dot was like rock bottom for several years.
Yeah, does he justify the relatively rock bottom one that we saw with the expected 125 basis points of rate cuts this year alone, presumably from Stephen Myron at this week's meeting? Ultimately, we'll ask him that question. Maybe he agrees.
Jim's a good sport. Looking forward to having this conversation and the back and forth with him at 7:30 Eastern time. Let's take a beat and get into the market. Equity futures unchanged on the S&P 500. Really nice day of gains, broad day of gains through yesterday on the S&P, the Nasdaq, on the Russell for the last 2 months. 7 consecutive weeks of gains for small caps. Is this a head fake or is it the real deal?
And how much can it really gain legs unless you see confirmation that consumers can keep absorbing some of the price increases? We've had conflicting views, whether it's a head fake, whether it's something that's real. A lot of people coalescing around the idea that there is a real broadening out. The Russell 2000, though, is a separate bunch of companies that is smaller and tends to have shifted over time. So that particularly isn't necessarily what people are talking about. Everyone keeps coalescing around the idea, if there's a bubble, maybe you want to buy because this bubble still has legs. And so ultimately the valuation story isn't really doing it for a lot of people.
The run continues, even as the interest rate story stabilizes. In fact, the Federal Reserve fell well short of market expectations, and yet the run continues for small caps. In the bond markets, 2s, 10s, 30s look like this. Your 2-year bond yield up a single basis point to 357, 10s up 2 to 412. Want to turn to foreign exchange and get to dollar yen? Dollar yen in focus. The Bank of Japan meets, nothing happens. Except something did happen. Beneath the surface, 2 people said, you know what, I think we should hike interest rates. That was a bit of news out of Tokyo this morning.
Yeah, that is the first time 2 people have said no to Governor Ueda and said, actually, we disagree with your policy. Not only that, and we made light of the fact that it will take 100 years for them to roll off their ETF portfolio on their balance sheet at the pace that they announced overnight. But that's important. It's an important signal. They are in a tightening mode, and that is going against some of the expectations in markets.
Dollar yen, 147.92, just about unchanged this morning. But that next meeting might bring an interest rate hike from the BOJ. Let's leave that one there. 3 hours away from the opening bell. Let's get you some morning movers. Back with us. Here's Yahira. Hey, Yahira.
Hi, John. We start with FedEx. Shares are rising 5.3% after it reinstated its outlook, saying that it expects to deliver 4 to 6% top-line growth in 2026. That is much higher than the 1% that Wall Street was expecting, and that is overshadowing what a warning from FedEx saying that it will take a $1 billion hit due to President Trump's tariffs. A lot of that having to do, of course, with lower shipments from China to the U.S. due to the end of the de minimis rule. And another company that reported earnings yesterday, but going in the other direction, is Lennar. Shares are falling 2.8% after profit there took another hit, falling for a 4th straight quarter as this company continues to offer big incentives to get buyers into their homes due to still elevated mortgage rates. And on top of that, its forecast for new orders also came in light, adding to challenges there. And we have Intel now just falling slightly down about 1/3% after Citigroup poured just a tiny bit of cold water on its massive rally. As you said, it was the best since the 1980s. Analysts there downgraded the stock to sell. They say that Intel's valuation, trading at 57 times earnings, is too rich, and that it factors in the success of the foundry business, which it sees little chance of materializing. And of course, the foundry business was not mentioned in yesterday's deal announcement with NVIDIA. John?
Yahara, thank you. Do you see the president's meme that went round in the last 24 hours overnight?
I missed that.
Him in front of like a Bloomberg terminal with one screen, bought for 20. The other screen now at 30.
Well, I mean, yes, I did see that actually, and I wasn't sure if it was real or not, but the reality is he has become the ultimate businessman in a different kind of way than a president has ever become before in terms of orchestrating deals and taking stakes in the likes of Intel. And it raises a new question for investors in a space. Is this going to be nationally strategic, and how much of a tailwind does that actually give it?
Pierre Ferragu of New Street Research joining us in about 10 minutes on this conversation. On our radar this morning, a phone call between US President Donald Trump and Chinese leader Xi Jinping scheduled for 9 a.m. Eastern Time. Trade negotiations and a potential TikTok deal will be at the forefront of the call. Elsewhere, another central bank facing internal divisions, the BOJ announcing a plan to offload a stockpile of ETFs while holding interest rates steady. Pressure building for a rate hike with 2 dissenting votes. And finally, Apple's iPhone 17 Pro models opening up to strong demand across Asia. New designs for the iPhone, Apple Watch, AirPods are rolling out in the United States today.
Yeah, and there evidently were long lines even in China to get some of these new iPhones. I hadn't realized it was a new rollout since 2020. I hadn't realized that this was that kind of upgrade. I think the real question will be, can this defy a lot of the skepticism around Apple and how much it's been an underperformer in the Magnificent Seven, despite they're not necessarily getting the AI capabilities, although maybe we'll get it with an update.
I came through 58th Street this morning, had a sneak peek of the line that was starting to build.
Yep.
Nowhere near what it used to be, of course. One lonely tent at the front, a few people lying down on cardboard boxes, that kind of thing, some people standing up. Wasn't that long at all.
Yeah, and there was a camera, though, for people to film the line that was assembling. I did notice that. It wasn't that long, and I wonder how much this is a tell in terms of demand and how much this is just people ordering it online, because it's really not fun to wait in line.
It doesn't mean what it used to mean.
Exactly.
People have figured out you don't have to do that to get it. Just go through other channels.
I don't understand the allure of that. I've never understood the allure of camping out in line
when you go in.
And clapping. I mean, honestly, I went to a Krispy Kreme opening in the Midwest when I was very young and covering news in a different capacity. Real news. And it was a Krispy Kreme opening, and there were people camped out around the corner, and I was just not understanding it then, and I still don't understand it
They sort of
now.
clap you when you walk in.
Oh, yeah, they're so excited. They camp out. It's like real event.
I don't think investors are clapping. That stock has underperformed the NASDAQ by something like 20 percentage points so far this year.
I saw what you did there. That was pretty good. I mean, look, that's the truth, is that investors need to be impressed. My question is, how long will it take? Because it's also, there are delays and people have to order them, and there's a 2-week delay, evidently, at least so far in China.
That's the latest on Apple so far this morning. Let's stay on Wall Street. FedEx reporting better than expected earnings, but warning of a $1 billion hit from trade volatility this year. Marissa Adams, the Europe and America's regional head of global trade solutions at HSBC, joins us now for more. Marissa, welcome back. We've got lots to talk about with you, including the latest developments in the UK. I just want to start with mitigation strategies. It's something you give us an update on every time we talk. What are the mitigation strategies now, and how sustainable are they? Are we reaching a point where corporations have got to make a decision, either cut some costs or pass this on?
Thanks, Jonathan, and good morning to you and Lisa. We are getting to a bit of an impasse now where there is only so long that companies can delay their investments, delay their decisions in terms of rejigging their supply chains or looking for new demand markets. And we've obviously seen a lot of first movers actually act quite quickly. But we are getting to a point now where the uncertainty, rather than the level of tariffs, is going to be a challenge.
Well, you say that, and that a lot of people come on this show say peak uncertainty is behind us. And actually, there is enough stability in the trade picture.
Sorry,
for
Lisa,
companies.
I've lost you. I can't actually hear you.
Let's try to reestablish that. Can you hear me now? Let's try to reestablish that. But John, that's the question to me, though, is, she was saying that the uncertainty will still remain an issue, while so many people have come on the show and talked about how there is a greater degree of certainty now, which gives companies the ability to make the decisions you were talking about.
Frances Donald, what did she tell us? RBC. She said we're getting to the point. Marissa Adams was alluding to it. We're getting to the point where corporations have got to think about what to do here. Cut costs, lay off labour, pass it on. Price hikes. It's exactly what Mike Gapin of Morgan Stanley is thinking about too. A lot of people might be surprised by this and say you're just market to market, you're pushing this off. Many people said at the very beginning, you're not going to see this overnight. It will take time. This is a process. First, you had to get through the pre-tariff inventory. There have been other mitigation strategies that were implemented. Now we're going to get further and further through the year into the start of 26. You get close to decision time. It's a decision they're going to have to make.
This is the reason why the Christmas shopping season, and we keep talking about it, and I realize it's still September, it's a reason why it's going to be so important. How much are consumers willing to accept some of the higher prices, and how much will some of these companies have to continue with the cost mitigation plans? And that, I think, is what a lot of people were thinking about. Marissa, I think we've reestablished you. Sorry about the technical glitch. I'm wondering, can you get a sense of how much is hinging on the Christmas shopping season and the idea of how much consumers are really willing to adjust to higher pricing?
You know, we've seen two sides of this, too. I think, firstly, we also saw the supply come forward for that shopping season, which is obviously critical, and we saw a lot of front-loading coming through earlier in the year. But whether those costs have actually been passed on at this stage, I think, is yet to be determined. I was in a large big-box store yesterday, and obviously all of the Christmas attire is in, and all of those goods are there already. So I think that might be a little bit earlier than before, but whether they've actually passed on costs at this stage is yet to be seen. I think what's kind of interesting, and, you know, we've been talking about, you alluded to at the beginning, the U.S. And U.K. trade discussions, obviously the trade state visit here from the president. Really interesting that whilst we obviously have this huge focus on goods trade, and I've spoken about it before with both of you, services trades really remain something incredibly critical, and actually very much an area where, if you look at the economies of the future, where we're trying to grow, something that they're putting an extra emphasis on. The economic trade agreement that was reached, and particularly the tech agreement that was announced, about $200 million in investment here into the UK, really critical. And we're seeing that clearly there are delays in some of the tariffs that are coming through on goods, but that isn't stopping businesses where services are a key component to actually growing and moving forward.
So it means that the services businesses can have that greater degree of certainty to make decisions. I just wonder, you talk about a greater degree of coalescing around some sort of agreement between the U.S. and UK. I want to talk about China and this phone call between Xi Jinping and President Trump later this morning. And I just wonder how much companies that you work with, that you advise, have completely written off China trade or have tried to completely immunize themselves from that supply chain just because there doesn't seem to be a definitive end to the uncertainty that you say is so paralyzing.
So I think one of the key challenges with China and the U.S. is that the China supply chain is very, very well built up. There's a huge amount of reliance between the China and the U.S. on that. So the idea of shifting completely away just isn't really possible for a lot of companies, whether that's in consumer retail, automotive, some of the advanced manufacturing, even in the pharmaceutical sector. So there are obviously elements that they can rejig and look at other areas, but this is a critical goods supply chain for the United States, and any sort of certainty as that comes through on where those tariffs land will be welcomed by the corporates that we work with.
Marissa, my apologies for the technical problem a little bit earlier. We'll have a longer conversation next time. Marissa Adams there of HSBC. It's a process. It's not a one-off event. I know it sounds boring. We all sound like a broken record, but a lot of people still expect to see some damage in the months to come.
Yeah, and damage on which side? On the idea of inflation going up for consumers, or is it going to be damage in terms of companies looking to cut back further, and that comes with layoffs? And that's sort of the tension playing out. So far, it's been a little bit of both, or maybe not layoffs, but attrition. And now it kind of has to come to consumers. And are they going to be okay with paying $8 for BlackBerries?
You're clearly not.
Yes.
Based on what you've told me repeatedly.
The truth is, I'm not. And then, I really want BlackBerries. And then I do it. And that is the key. And maybe that is an indication of things to go. Please do not use that as your benchmark.
Okay.
Inflation.
I don't think anyone is. Don't think there's any danger in that.
I just wanted to, that's sort of the dilemma for people.
We appreciate the update.
Thank you.
When we've reached the limit of your tolerance, you let us know. And then we know we've got into some trouble, all right? Futures right now on the S&P, just about unchanged. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump is asking the U.S. Supreme Court to allow him to dismiss Fed Governor Lisa Cook while she challenges his attempt to remove her. The Justice Department asked the court to at least temporarily pause a federal judge's ruling that has allowed Cook to remain in her position for now. Her lawyers have warned that even a temporary disruption to the status quo could impact the U.S. financial system. Meanwhile, President Trump says U.S. broadcast networks should face license scrutiny if they're too critical of him. Trump had earlier praised ABC's suspension of Jimmy Kimmel over his comments about the late conservative activist Charlie Kirk, and also filed a $15 billion lawsuit against the New York Times earlier this week. Both incidents have spurred worry, specifically among Trump critics, about free speech in the United States. And a household staple, which has seen huge inflation, might get saved from tariffs. The Wall Street Journal reporting lawmakers are planning to introduce a bill to kill levies on coffee. The bipartisan legislation would exempt coffee from any tariffs imposed after President Trump came into office. That's your Bloomberg Brief. John?
Yahira, thank you. Of all the things, we mentioned frequency bias, right? I was reflecting on what Paul Donovan of UBS had talked about on this network. I think he caught up with Danny a few months ago, and he said that consumer expectations aren't shaped by what CPI and PCE are doing. It's frequency bias. What are the goods and services you frequently use, come across, engage with every day? Coffee's like the number one. It's the first thing people wake up to. If they see that move, 20% plus, that's going to shape their view about how the economy is and ultimately where prices are.
I wonder how much politicians have their own index of goods that people buy every day so that they don't have another egg emergency or an egg PR bust like what we got a couple of years ago with egg prices surging dramatically. Do they focus on coffee? Do they focus on cornflakes? Whatever people buy, I guess people are not buying cornflakes as much, but these are the things that actually do shape people's perceptions, and how much will there be an operation to address those specific
It's
things?
not the same basket the Fed is tracking, let's put it that way. Up next on the program, a revolutionary partnership.
This is a big partnership, and we think it's going to be fantastic for Intel. It's going to be fantastic for us. And we're building revolutionary products that's going to address some $50 billion annual market.
Up next, Pierre Ferragu of New Street Research, live from New York City this morning. You're watching Bloomberg TV. Equities going nowhere on the S&P 500, pretty much unchanged as well. Likewise on the Nasdaq, on the Russell 2000. Let's get to the main event for corporate America through this week. The biggest story, I would say worldwide, under surveillance this morning, a revolutionary partnership.
This is a big partnership, and we think it's going to be fantastic for Intel. It's going to be fantastic for us. And we're building revolutionary products that's going to address some $50 billion annual market.
This collaboration brings all together for the best for the industry going forward. This collaboration is unleash the new era of 86 innovation.
So here's the latest this morning. Intel shares seeing their biggest single day jump since 1987, with Nvidia agreeing to invest $5 billion for a minority stake in the chip maker. Pierre Ferragu of New Street Research raising its price target on Intel to 32 while maintaining a neutral rating for Nvidia. They say this: Nvidia saved the product business. The partnership gives Intel the possibility to regain commercial momentum and play a central role in both the server and the PC markets. Pierre of New Street joins us now for more. Pierre, welcome to the program, sir. It's good to get your thoughts. It's good for Intel. What does Nvidia get out of it?
It's a good question. Nvidia gets a lot of positive elements out of these partnerships. First, they build goodwill with the US administration, making Intel like a strong player in the global tech ecosystem is a priority for the administration, making the company, one of the best assets we have to maintain leading edge manufacturing in the US. Then second, very simply, a lot of NVIDIA clients were very keen to be able to have x86 within their giant NVIDIA clusters. So NVIDIA is simply answering a very simple request from these clients. And last but not least, with the incredibly dominant position NVIDIA has in the data center world, it's always good for NVIDIA to show that they are not abusing their dominant position. And so opening NVLink, partnering with other players, giving access to other CPUs, in their GPU clusters is actually a very good thing to do. Then the downside for NVIDIA is virtually nothing, because as Jensen put it yesterday, it's going to be about either selling ARM CPUs they purchased from TSMC or selling x86 CPUs they purchased from Intel.
Pierre, how much is this about the cooperation in developing chips and GPUs, and how much is this about the actual foundry? And this is sort of a distinction I'm not clear on.
Yeah, so the answer is actually very straightforward. Today, there is absolutely nothing about the foundry business. We don't even know whether these chips are going to be manufactured at Intel or at TSMC in reality. It's still an open-ended question. Remember, Intel is a very important client to TSMC. So anything about foundry would be like the second act or the part two of the turnaround effort of the new incoming CEO. And today, there is nothing about it. It's all about being able to put an x86 Intel chip within the scale-up fabric, like this very high-speed interconnectivity between chips that NVIDIA has developed.
The way that we've been talking about it, the way that I've been thinking about it is that the U.S. is taking a stake in Intel and maybe pushing others to do the same because of the self-reliance, or the future self-reliance or the hope of it on making chips in the United States. Is that the wrong story? Is that actually not the hopes and dreams of Intel? It's just survival to fight another day?
I think you're actually right, but it's both. So Libutan, the new CEO, has a very clearly laid out plan, and he has like a list of, I think, 10 priorities. One of these priorities is regain leadership in his product business. And that deal is really about that, and it's very important. Without leadership in their product business, it's going to be very difficult for Intel to be successful anywhere else. And one of the other priorities is about strengthening his balance sheet. His predecessor has been on a spending spree, investing a lot in manufacturing capacity. Now, for Libutan, it's time to rebuild the balance sheet. So the combination of attracting the US government, SoftBank, NVIDIA, and potentially others onto the balance sheet with cash injections is very important to Intel overall. And of course, Intel being strong, having a strong balance sheet and having a strong product business is critical to increase the chances for Intel to be successful as a manufacturer. So all that actually holds together. There isn't like a foundry versus product story for Intel. Intel has to restore both ends of the business.
Pierre, just a final question from me. I think we're all pretty familiar with how the West views Huawei, for instance. What I don't have the understanding of right now is the evolving view of China on Intel. Now the government has taken a stake, and effectively this has become a new baby investment for the White House, Pierre. What do the Chinese think about these developments?
That's a good question. Intel has been probably slightly below the radar screens of the Chinese for quite a long time, and now that Intel is coming back into the game, the question you're asking is going to become more and more relevant. And I would say historically, in the trade tensions, Intel has always been like a fairly protected player because of the strength of their ecosystem. The Chinese have a lot of very simple, very mundane, but very critical workloads running on x86, Intel x86 chips that would be extremely difficult to migrate just because of ecosystem dependencies, all these software dependencies that rely on what's available in your existing, specifically Intel x86 environment. So probably for China, Intel is going to remain a target that would be very expensive to hurt, and that wouldn't really present a significant stake. So probably Intel is going to be all right in China. That would be, at this very early stage, my bet.
Interesting. It's a big piece of their business, of course, their revenue out of that country. Pierre, appreciate your take. Pierre Ferragu of New Street Research. Lots to think about. Intel in focus. I can only imagine if the shoe was on the other foot, how we'd be talking about these developments if they were taking place in China.
Yeah, I think it's a great question. I think that it really highlights the potential risk of making it a state champion in the United States. I wonder what China thinks of Jensen Huang's relationship with Donald Trump, just in the same kind of vein, to see Jensen Huang with President Trump at all of these diplomatic meetings. Does that raise questions about how much to push away from using NVIDIA's chips, just to build on the point you were making?
We're always landing on the same question. Can he continue to keep one foot in each market? How sustainable is that position?
Do we have an understanding of what the ultimate relationship is and goals? And the answer is not yet.
Up next, Sarah Hunt of Alpine Saxon Woods, Jeannette Lowe of Strategas, and the former St. Louis Fed President Jim Bullard. All of that in the next hour on Bloomberg Surveillance.
this isn't just about the Fed, this is also about the path for the economy.
We've got a very K-shaped recovery, and I think people overlook this.
It's hard to put a pin that you can see a clear direction for the economy.
There are reasons to be concerned about this labor market.
The presumption is that tariffs are a one-time price adjustment, and you're going to have inflation start to move lower.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 totally unchanged, following a really nice day of gains, heading towards a third consecutive weekly advance for the S&P and the Nasdaq. Make it week 7 for the Russell 2000 this morning, down by about 1/10%. In the bond market, 2-year, 10-year, 30-year bond yields stabilizing around 360, 350 on twos. Even as the rate story stabilizes, the run continues for small caps, even as the tension builds worldwide over what happens with tariffs. This market has moved on. Can you move on from this? At 9 a.m. Eastern Time, the president sitting down for a phone call with President Xi Jinping of China. The market's moved on. Can we move on?
Right. How much more uncertainty is potentially going to get reintroduced from this call? A lot of people expecting just simply a deal on TikTok, maybe to set the stage for an in-person meeting, and then maybe we get more certainty from the idea that we can kick the can down the road. Nonetheless, it hasn't been a stagnant story, and this is the tension right now. Can you have full reliance on the Fed's backstop to the economic growth picture if potentially companies are forced to make cutbacks in staff and potentially pass along price increases in response to the ongoing tariff story?
Jobless claims fell back. That was some good news. So that was all Texas, some odd filings. We can move on from that. But elsewhere in the labour market, it's difficult to find good news after a massive step down that we've seen in payrolls. And that's the odd dynamic that's emerged over the last 2 months. The equity market's living in 26. It's an anticipatory asset class. Everyone else in the real world is living in 2025. And in 2025, they're still worried about labour. They're still worried about getting a job. You can see that in the surveys. They're still worried about prices and the prospect they go up from here. I hope, sincerely, for the sake of the economy, that this equity market is right and that in 26 we get this pickup, this reacceleration, and the outlook for the labour market improves.
And I think that we won't really know whether it's right or wrong until we see consumers and the Christmas shopping season. I keep going back to Christmas shopping, but every retail executive who I speak to says it's a mystery right now. It's unclear exactly what consumers are going to be willing to absorb. And people say they don't feel good, but they continue to go out shopping. The problem is, and Neil Richardson put this well, that until you get an ongoing reacceleration, you cannot get the training programs to shift the dynamic to increase labor in a more meaningful way in a vastly different sphere where you've got different types of technologies and, frankly, different types of jobs that are required in an economy that's rapidly changing in terms of trade, in terms of production.
And I know this is super uncomfortable to talk about, but the bottom line is the stock market's not the economy. The stock market has been trading on the capex intentions of a handful of companies. And when I talk about the stock market, I'm talking about the S&P 500. And the labour market data just hasn't been relevant to the earnings story of some of those big names for now. Don't know if that changes, but that's the story for now. The payroll story has been relevant to the Federal Reserve. So if you're an investor investing in that AI story, you've got both the earnings and guess what? The Fed's cutting too. You're getting the best of both worlds at the moment.
That's the reason why Michael Hartnett of Bank of America said, yes, it probably is a stock bubble when it comes to the Magnificent Seven, but that means that it's going to keep on expanding because ultimately there's nothing that could potentially stop this. If this does continue, you keep saying the stock market's not the economy, and we both keep saying that. Who was it? Was Alex yesterday, Altman, who came on and said, actually, increasingly, it does have a ramification for the economy because of the wealth effect, but just not for everybody. And so that's the reason why the K-shaped economy continues, because people who are experiencing the wealth effect can go out and buy $8 Blackberries.
Nasdaq futures up by about 0.1% on the S&P, up by 0.05, measuring the wealth of this country through the price of Blackberries throughout this morning, apparently. Okay, we move on from that, Bramo.
I think we can.
Okay, good. Coming up this hour, Sarah Hunt of Alpine Saxon words with investors going all in on a new chip partnership. Jeannette Lowe of Strategas as a Trump Xi call paves the way for a high-stakes meeting. Plus, a little bit later this hour, the former St. Louis Fed President Jim Bullard with the White House casting a wide net to replace Chairman Powell. We begin this hour with stocks hitting new all-time highs after a major tech rally. Sarah Hunt of Alpine Saxon words writing the continued ramp in capital spending on AI, as well as the long-term need for spending across the infrastructure space, continues to capture investor attention and capital. Sarah joins us now for more. Sarah, good morning.
Good morning.
Payrolls just aren't relevant. Is that the feeling at the moment?
They're relevant for a lot of people for whom that matters to get a job or not get a job. For the investment case of AI, payrolls is not that close to it. These are not highly people-specific businesses. In a lot of cases, this is a lot of investment that's going into automating a lot of things that people are actually doing. So I think that there's a tension between both the spend there and the ultimate result of that spend.
Do you think there's limits to that divergence?
There will be, but at the moment there doesn't seem to be. And it's interesting that you mentioned the fact that people are not paying as much attention to that on the stock market being the economy and not being the economy, because there is this hopefulness in equity markets that we are going to get through all the risks that we had before, that this spending is going to carry a lot and earnings are going to continue to come in very good. If we start to see a tension from that, where payrolls falls into that is, if I need to keep my earnings up and I need to worry about margins, that can be a payroll problem down the line. Right now, it doesn't seem to be the biggest issue. I think there are other issues, but it's out there.
One of the reasons why it's not the biggest issue is because there isn't a lot of other evidence of weakness. When we talk to a lot of CEOs or CFOs, they speak about a reacceleration heading into the end of next year. They talk about CapEx plans coming together. They talk about the stock price actually bolstering their abilities to raise capital, spreads at the lowest rate since 1998 on investment grade. How much is that really the ultimate tell? That maybe there's just a new normal of low fire, low hire, but there isn't really that much weakness in the underlying economy.
I think one of the biggest problems, and one of the reasons it's so difficult to parse out the labor statistics, is that you had a major change in the labor market with the immigration shift. And so that makes it difficult to know what's the right number for payrolls. What is an economy that is ticking along at a reasonable pace? And it's hard to see that given the historic numbers and also sort of what's gone on and how the economy is changing at the same time, because you still have a lower level of incoming jobs. And this is a problem for younger people trying to get a job, because AI in a lot of cases can replace some of the lower level stuff that people used to hire younger people for. There's so many different pieces going on. It's hard to pick out what's the most important piece.
This is mind-spinning stuff. And anyone who's been following this and trying to follow themes and trying to coalesce around them probably feels as exhausted as I do right now. And what I wonder is how much people, because of that exhaustion, are saying ultimately it doesn't matter because the Fed is underwriting risk. Right now what's going on is a Federal Reserve that's saying that it will cater to any kind of growth, even if inflation is hotter. And so that is just a recipe to buy stocks.
I think it's hard to fight the Fed. I was a little bit concerned that it was going to be buy the rumor, sell the news, and as soon as they cut that the market might take a pause or take a breather here. It doesn't seem to, at least as of yesterday, but it's still fairly early. I think that it's difficult to figure out exactly where we're going in a situation where there are so many pieces moving. Were we too restrictive to begin with? Do interest rate cuts really help the problems that we're having on the employment side? Because it's not about necessarily rates as much as it is about a changing labor market and shifting dynamics that may be structural. And how do we figure that out in the near term? Cutting rates, the 25 insurance cut that says we're not sure exactly what's happening, we may get an acceleration in inflation. It's a little bit of a dichotomy that's going on at the same time, and they're trying to solve for all the variables, and I'm not sure what that solution is. And I think that that's the problem. And then you have equity markets hitting all-time highs, and you think, okay, well, does that just keep going? What stops it?
It's an odd situation. If I told you before the start of the week what the Federal Reserve would do and how Chairman Powell would characterize that interest rate cut, I don't know how many people would have said that small caps would have been up 3% this week. That's surprising to me that interest rate expectations, at least projected by the Fed, have stabilized here. And they are well below, or above for that matter, where the market is for 2026. And yet here we are still talking about small caps ripping. Can you explain what's happening there?
I can try. What I can say is that the less interest rates are arguably better for small cap stocks. If we are looking through the tariff implications and saying that the U.S. economy is going to do better, which the Fed gave you a little bit of information on both sides there, then that is good for small caps. People are also looking for places in the market that hadn't been reaching new highs on a regular basis all summer long. So the small cap space did that. The small caps are also tend to be more U.S. centric. So if the U.S. economy is going to be ticking along, that's good for them. The question really is going to be, where do we end up with those statistics? Because right now, there's a little bit of push-pull in almost everything you look at.
I'm just starting to get the feeling that we're not trading this chairman anymore. We're trading the 2026 Fed led by someone else. Do you sense that too? Is that what you're starting to see, not just in equities, but maybe in gold as well?
Well, I think that the tension about where rates should go is obviously being looked at with the entire political situation of what's going on at the Fed, and there will be a change in leadership. But I don't think that you're going to end up with a bunch of people who are just willing to look through whatever's going on economically and saying, well, just because we had a change in leadership, we're going to have to change our policy. If the data on inflation gets much worse, it's going to be very difficult for that to play out for the Fed to keep cutting rates. And I think that what they're trying to say here is, yes, we see this and we see that, so we're going to start here. The next decision is going to be a hard one, and the next press conference is going to be even harder, I think.
So I hate to ask this, but what's your highest conviction right now?
I'm going to have to agree to some degree with Michael Hartnett and say the technology is continuing to do well. That spend is there. Whether or not we want to make a corollary to other periods. I mean, in the 2000s, 1999 to 2000, a lot of the vendors were financing their customers. That's not happening now. These companies have the cash and they're spending it. The question is going to be what happens when that CapEx starts to come down, because that's going to be a real issue. But we're not there yet because we're not at peak CapEx. And every year we think we are. And then you get a whole bunch of announcements and people say they're going to be spending more money. That's a problem for cash flows for these companies, but they're generating so much cash, they're still in the lead. So I think it's hard to argue that. Even though there are other areas that I like, they don't always play out so well.
I don't know if that's the high conviction call, but it's certainly the most comfortable call for most people we speak to.
Ultimately, you can make a story and you can understand it. The rest of it, I'm not really clear on how you understand the story because the story is still being written and it's really difficult to get your head around.
Sarah, it's good to see you. The bias is to buy. That continues. Sarah Hunt of Alpine Saxon Woods. Equity futures on the S&P just about positive with an update on stories worldwide with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Hyundai says it's going forward with plans to expand the Georgia facility raided by U.S. immigration authorities earlier this month. The car maker says it will spend $2.7 billion to increase productivity at the EV battery plant over the next 3 years. The ICE raid and subsequent arrest of hundreds of South Korean workers had delayed the opening of the plant by 2 to 3 months. Meanwhile, U.S. law enforcement is building a profile on suspected Charlie Kirk shooter Tyler Robinson. Sources say the Secret Service has joined the investigation into the shooting, even though Kirk wasn't under the agency's protection. Plus, the organization Kirk ran, Turning Point USA, now says Kirk's wife, Erica, will serve as its next CEO. And the CDC's vaccine panel has voted against administering Merck's combination vaccine for measles and 3 other viruses to children under 4 because of the small risk of seizures. The panel is now calling for that age group to get 2 separate shots. Merck warns the decision poses significant risk to public health by undermining confidence in vaccines. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, Trump and Xi talking TikTok.
I'm speaking with President Xi, as you know, having to do with TikTok and also trade, and we're very close to deals on all of it. It sounds like they've approved TikTok, and TikTok is a tremendous amount of money for the United States.
That conversation up next with Jeannette Lowe of Strategas, live from New York City this morning. Good morning. You made it, heading towards the weekend at all-time highs across the board here on the S&P, the Nasdaq, and the Russell too. The weekly advance continues. Make it 3 for the S&P and the Nasdaq. Make it 7 for the small caps, even as the bond market stabilizes. The front end of the yield curve really hasn't done much this week, even as this Federal Reserve does fall short of expectations for 26.
We even had someone predicting a potential hike heading into next year, and people dismiss that as irrelevant because it won't be relevant for a Fed and the FOMC composition of next year. Really what was notable, and actually we just were talking about how people were expecting you get a sell-off if there was a disappointment, sell the rate cut. It's been anything but, and that, I think, is a question to unravel exactly why that is.
Two-sided risk, no risk-free path, risk management. That was a much more balanced Chairman Powell than I think people were looking forward to, and yet here we are, looking ahead to 26, and I have to think it's because it's not really about Chairman Powell anymore. It's about a different Federal Reserve next year, and that conversation with Jim Bullard in 15 minutes is really quite relevant.
Yeah, how much has the paradigm shifted where there is a growth prioritization and there is the third mandate for the Federal Reserve of moderate long-term interest rates, which is a new one, a third one, and might take on a very real meaning.
We'll catch up with Jim in about 15 minutes' time. Look out for that. Under surveillance this morning, Trump and Xi talking TikTok.
I'm speaking with President Xi, as you know, having to do with TikTok and also trade, and we're very close to deals on all of it. And my relationship with China is very good. You know, we have a trade deal with them. We had a very good meeting the other day, and it sounds like they've approved TikTok, and TikTok is a tremendous amount of money for the United States, so that was nice.
So here's the latest this morning. The fate of TikTok now centering on President Trump's phone call with Chinese leader Xi at 9 a.m. Eastern Time, with details of a framework agreement announced earlier this week, yet to be announced more formally. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the programme. Let's just talk about TikTok and whether this is the only issue for this phone call today, or whether the bar is a little bit higher. Can we expect more than just that?
Well, John, really at this point, it feels like TikTok might be the most tangible deliverable that we get from this call, because as our analysts at Bloomberg Economics point out, we really haven't seen much progress when it comes to whether or not the negotiators are really making that progress on some of the core demands that this White House is looking for in the trade talks. Because up to this point, the talks have really all been about making sure that de-escalation remains in place. We heard President Trump yesterday telling reporters in the United Kingdom that he is considering extending that tariff truce. The deadline is, of course, on November 10th. And that's because there's likely a whole range of issues that still really do need to be addressed. Everything from the mounting pressure on Nvidia to the U.S. wanting to see China curb its imports of Russian energy supplies. And I'd also point out, perhaps most pertinent ahead of the call today, market access for U.S. goods, as new data analyzed by Bloomberg shows that China hasn't placed a single order for U.S. soybeans so far this export season, which just started a few weeks ago. Now, perhaps this is really being viewed as setting the table for a broader discussion between the two leaders. It is widely viewed as a precursor for a potential face-to-face meeting next month at the APEC summit in South Korea. So, John, at this point, we're trying to see if we can glean any details on that front, but then, of course, awaiting those details when it comes to TikTok. Bloomberg News, of course, reporting on the potential framework of what that deal will look like, including that group of outside U.S. investors, existing investors, and then leaving ByteDance with a less than 20% stake in the company.
Tyler, thanks for the update. Tyler Kendall there outside the White House this morning. Joining us now to extend the conversation, Jeannette Lowe of Strategas. Jeannette, welcome to the show. You just heard from Tyler there talking about Chinese and the lack of buying of soybeans here in America, important to core Republican districts and states in this country. Jeannette, do you think we're any closer to nailing down those purchase agreements that really dominated the conversations back in the president's first term?
Yeah, it's a great point, and thanks for having me on. So I think that there's a lot of talk about whether or not there's going to be this grand deal between Trump and Xi, and I think I'm a little skeptical about that happening. What we've seen is what Tyler kind of mentioned. It's this de-escalation. It's kind of maintaining the status quo while there is this decoupling of the two countries, and you're seeing that with the fights over NVIDIA chips and critical minerals coming to the U.S. and then U.S. sending ships over to China, and then also this piece about the agricultural the soybean purchases. So I think what they're trying to do is they're showing their pressure points on various sides to get a particular deal. This, I mean, may all be about TikTok, but then also trying to get some of these other pieces in place, trying to get companies in China to actually buy NVIDIA chips after Trump said that he would allow that, getting them to actually buy these soybean purchases, which obviously, as you said, would be really important for critical constituencies in the U.S. for political reasons. And so then that's kind of, I think, where we're going. So it's going to probably be a smaller deal and trying to figure out how do we maintain some sort of status quo, how do we maintain some sort of good trade relations, while at the same time we know both sides are kind of decoupling from one another.
This is the reason why, Jeannette, I think a lot of people are trying to understand how transactional this relationship is and how rooted it is in ideology on this idea of national security and trying to immunize the respective economies from one another. Is there any signal in what we might hear about from TikTok?
Yeah, I mean, I think the one thing that would obviously be important is what does happen with the algorithm. I mean, Trump has been less focused on the national security concerns that members of Congress have been with regard to the TikTok deal. And if that algorithm is still, licensed from ByteDance, I think that's kind of a sign that this is a little bit more transactional and less about national security. But to the other point, Trump is really focused on other key sectors where that's really much more the focus for him for national security. So he's much more focused on doing more domestic manufacturing of semiconductors, pharmaceuticals, defense components, things of that nature in the United States. Tech obviously is a big piece of that. The AI race is a very big piece of that. I think that's also what his broader picture is. So being able to help NVIDIA, I think, would be more instructive, almost more than TikTok.
FedEx came out last night and said that it was going to take $1 billion hit, partly because of Chinese deliveries that are going to be taken off the table for them or limited as a result of some of the changes in rules. A lot of companies have just moved on, and so have investors from this story. Is there anything that could come out of today or the next couple of weeks with the negotiations that you think a lot of companies, corporate executives, investors should be paying attention to that could reintroduce a level of uncertainty that really will make a difference?
Yeah, I mean, I think the bigger story is actually, so the call will be important in figuring out what deliverables there may be and whether there is something broader than what I outlined a few minutes ago. But I think also, obviously, what happens with the court case before the Supreme Court as to whether or not the tariffs that Trump imposed under the IEEPA trade authority, whether those can remain in place, that could be quite disruptive because we do think that the president has a backup plan that even if they're overturned by the Supreme Court, they will be reimposed under other means. And I think also we want to kind of watch to see if there is the opportunity for more other trade deals in this environment where it gets more uncertain. And then also kind of looking at these exemptions that keep popping up. We had the Japan trade deal and the talk about doing some exemptions for goods that the U.S. doesn't produce. We don't mine here, things that are important for aircraft and generic pharmaceuticals. And is there an increasing ability to get a hold of those exemptions? I think that could be important for the story larger going into the fourth quarter as well.
Jeannette, this exemption story, I think coffee and that conversation that was sparked by the report coming from the Washington Post, I think is really important. A Republican from Nebraska, a Democrat from California, reportedly introducing a bill to exclude coffee from tariffs. And Jeannette, that bill may not go anywhere. I've got no idea. Perhaps it doesn't. But that's the first real sign I've seen of Congress starting to impose itself a little bit here. And I would love to get your perspective on this, whether you believe that might be the first step of many still to come further down the road.
Yeah, there was another story as well this week about how members of the House were saying that they want a trade task force and they want to put a smaller limit on how long they can avoid trying to repeal the national emergency that Trump imposed for these tariffs. And I think one of these issues is the consumer piece. Coffee, bananas, things like that. Tuna is one of those exemptions. So I think there's also a focus on where are costs actually hitting consumers, and then what is the trade piece and the trade authority. So it does seem like, yes, Congress is trying to maybe reinsert itself. I don't necessarily know how much authority will be able to claw back. I don't think the movement is that strong yet. But I think if there were to be, a worsening economic situation, that is like kind of the impetus that you would need to actually see that happen. And we don't see that happening in the near term.
Jeannette, thank you. Appreciate your perspective as always and your opinion. Jeannette Lowe there, Strategas, looking ahead to what we could see on the trade front. They are already in campaign mode for midterms. That story right there, I think is worthy of more attention, even if you think the bill is going nowhere. Just how much of a push will you see building in the year to come?
How much is there a recognition that people are feeling this in a real way, even if it's not showing up in the data in the way that a lot of people are suggesting? This was what happened to Biden. And I think that really is in people's heads, where he was talking about how there is this recovery, how things are better. The data shows that things are better. But what consumers were feeling was the inflation. And he didn't talk about that story in the way that a lot of people were feeling it, and people were angry. And how much is that a lesson that a lot of people heading into the midterms are going to learn and are going to impose on things like coffee? I think it's actually a really important point.
President Biden and the whole team were detached from economic reality. The way they used to talk about the economy, that's a mistake that this administration and the Republicans do not want to repeat going into the midterms next year, that's for sure. Equities on the S&P 500 this morning, just about unchanged. We need a big conversation about the future of the Federal Reserve. We've got the perfect man to do it. A man on the shortlist in the Fed chair search, the former St. Louis Fed President Jim Bullard joining this program in just a moment. Plus, your morning movers with your hira and a trade warning from FedEx. They shake it off this morning. That stock is up by 5%. The opening about 2 hours away. Equities just about positive on the S&P 500 coming into Friday. heading towards the weekend, closing out the trading week at all-time highs across the board. That's the setup in the equity market. Let's get you some morning movers, some single names. Here's Yahira. Hey, Yahira.
Hi, John. As you said, FedEx is shaking off those tariff worries. Shares are rising nearly 4% after the company reinstated its outlook. It says that it expects to deliver 4 to 6% growth next year. That is way above the 1% that analysts were expecting. That's seeming to overshadow a warning, as I said, from FedEx that it will take a $1 billion hit due to President Trump's tariffs. Meanwhile, we move on to Tesla. It is seeing a lift here, up about 0.6% on some sell-side action. Baird upgrading it to outperform and raising its price target by 71% to $548, which represents about a 30% upside from here. The analyst Ben Callow says that Tesla's car sales have been slumping, of course, but the real story is physical AI, saying that long-term catalysts like robo-taxis and humanoid robots can drive shares even higher from here. And we end on another automaker also moving on some sell-side action. Stellantis shares are up 1.9% after it got an upgrade to buy by analysts over at Berenberg. They say that the inventory situation is improving, a turnaround from when we saw Stellantis cars piling up on U.S. lots. John?
Yahira, thank you. Appreciate the update. 3 names to watch going into the opening bell. On our radar this morning, one of our top stories, President Trump and Chinese leader Xi Jinping holding a call later this morning to talk trade and TikTok. Today's call laying the groundwork for a high-stakes meeting between the two, perhaps later this year. Elsewhere, President Trump saying U.S. broadcast networks could have their licenses taken away if they're too critical of him. Trump defending ABC's decision to suspend Jimmy Kimmel's show indefinitely over the host's remarks about the death of Charlie Kirk. And finally, President Trump asking the Supreme Court to let him fire Fed Governor Lisa Cook. The Justice Department requesting a temporary pause in a lower court ruling which allows Cook to remain in her position for now.
Yeah, and this was largely expected for him to appeal to the Supreme Court. Nonetheless, Lisa Cook was at the meeting this week. The bigger point here is that President Trump is clearly trying to put his stamp on the Federal Reserve, and clearly the market believes that that will happen to some degree and that there will be a prioritization of growth at the expense maybe of inflation, but there is a new paradigm and a new reaction function from the Fed, and maybe that is what we're feeling in terms of the market reaction to this week's meeting.
And ultimately, she voted for what the president wants, which is lower interest rates.
Yeah, although who knows what the dots are, right? This is all about the forward view. And if there hadn't been the sort of expectation that there would be a dovish overlay to next year's action by the FOMC, would the market have responded like this, given the fact that the Fed gave them less than what they were expecting?
Next year is impossible. And the spread for next year in the dot plot is incredibly wide. In fact, it's incredibly wide for the next 3 months. Never mind the whole of next year.
Yeah, one of the difficult things here, and I think this is really important to keep emphasizing, is that it'd be one thing if people understood exactly where the economy is going. But as we were talking about earlier, it's a mess. It's very difficult to get a clear read. There are a whole variety of views on Wall Street about what exactly is going on, and there are different narratives that are at crosswinds with one another. So there is an honest economic debate to be had here. You overlay the desire for just lower rates in general, and you have a whole lot of confusion leading to a potentially more accommodative Fed. Buy stocks.
Let's attempt to get a clearer view on things, not just buy stocks. Let's talk about the future of this Federal Reserve. The White House casting a wide net to replace Fed Chair Jay Powell. The U.S. Treasury Secretary Scott Bessent praising a, quote, very good meeting with the former St. Louis Fed President Jim Bullard during his search. Jim joins us in the studio for more. Jim, good morning.
Good morning.
Thanks for being here. Not many people get to experience what you've just experienced, sitting down for a conversation to potentially become the Fed Chair. Can you walk us through what that was like? What's the process like?
Well, as you say, they have a lot of people on the list, and they're following through. It's a transparent process. I think that's good. I think I know virtually all the people on the list. I think they're all good. So I think this was a meeting just to talk in broad terms, but I can't really report out details of what was said.
The Treasury Secretary incredibly dialed into the economy and financial markets. I'm sure you experienced that in your conversation with him. I think you can share with us the kind of questions I imagine that he's asking you when I ask them to you, which essentially is, how do you view things right now? How do you think about the labour market?
I thought the Fed's decision was a good one. This looks like a sequence of 3 moves in a row through the end of the year. Of course, you want to be data dependent, and the chair stressed that in the press conference. But I think the committee was worried about the non-farm payrolls report that revised the previous months down considerably. Non-farm payrolls is kind of the key number for the Fed. So I think that made them a little bit nervous. There are stories that you can tell about why that's happening, but on the other hand, it could be weakness in the labor market. So I think that tilted things toward a little bit more dovish policy. So they brought October into the picture. And now you've got markets pricing probably 75 by the end of the year. That would be a significant move by the end of the year, and they have a little bit of optionality if the data goes the other way. So it's a pretty good decision from the point of view of how this works.
You said they have optionality if the data goes the other way. How high is the bar for strengthening the economy to really prevent the Fed at this point, given everything from going 3 times this year?
Yeah, I think the committee's also spooked a little bit by last year, because last year the data looked weak but then turned around abruptly, and so they'll be nervous about that. It's hard to say exactly how high the bar is. That's a judgment call that'll have to be made by members of the committee.
There's this other disagreement on the Fed, clearly. There are a lot of them, and understandably, because in Wall Street there are a lot of disagreements as well as to what the economic backdrop is. But you could see a spread in terms of where the neutral rate was from, say, 3% in terms of the long-term dot for some of the Fed members, or 4% for some of the others. Where do you sit?
I think it's still fairly low, so you could argue maybe 3.25 or something like that. So if you're still above 4% with the policy rate, you're still 100 basis points above. If that's your number, so that's why I've been saying they have room to maneuver. They have room to come down some on the policy rate and still put downward pressure on inflation. Inflation is still above target and, has been debated at length over the last 6 months or so. But I think they're in pretty good position right now.
How credible do you think the pursuit of 2% actually is?
I think the committee is very dedicated to the 2% target. I think it would be foolish to abandon that target. It has set an international standard across all the countries of the world. And if the lead economy says, we're going to back off that, then all the other countries would back off. You'd be back into the 70s and you'd have a lot of chaos. So that is not a good idea, and the committee will try to get back to 2%. However, I think you want to get back on a nice, smooth, asymptotic path to 2%, and the forecasts always show that, and that's always the way the Fed thinks about it.
The 2-year rolling view. Now, some people might say that's aspirational, magical forecasting. It's just we're always forecasting this 2 years out, but never actually hit it based on history, which raises the credibility question. The Federal Reserve's cutting interest rates with inflation closer to 3 than it is to 2, with unemployment closer to 4 than it is to 5, and with equities at all-time highs. Is this the right time to back away from that restrictive monetary policy that's going to lead to that glide path back towards 2%?
It's restrictive, but even when they come down, it'll still be somewhat restrictive. I think one of the pieces of risk management you have to think about here is suppose the economy is tipping into a marked slowdown. Then the committee would want to be accommodative in that circumstance, and you'd want to be below your neutral rate. So you'd have a long way to go. You'd have to really scramble if that happened. I'm not saying that's the base case, but that's a possibility. And so you probably want to be a little bit closer to neutral so you didn't have to work so hard if you got into that scenario.
One of the tests for a lot of people is if inflation does go up, maybe say at the end of this year, early next year, which a lot of people are expecting that it will. What's the Fed's response? Do they keep cutting, or do they look past it as simply a one-time price adjustment?
I think they've made pretty clear that they're going to look through temporary tariff effects, and then they expect inflation to resume its downward trend. And the effects have been muted. U.S. Trade Representative does not have an inflation target, so I think that it's up to the Fed to determine what the inflation rate is going to be, not trade policy. But so lots of things affect inflation, and then you have to get on your sort of medium-term path, and I think that's what they're doing.
You mentioned earlier that there is a degree of fear of repeating what we saw last year, where the Fed cut by 100 basis points and we saw the long end of the yield curve rise by 100 basis points and economic data pick back up. And I just wonder how much you think the Fed is open, or you would be open if you were on the Fed now, to adjust some of the balance sheet composition in response to any move in the long end of the yield curve.
I think the balance sheet policy has been in the background. I think that's appropriate. The committee has been shrinking the size of the balance sheet, a little bit slower pace recently, but I think they're pretty happy with that policy for now. They want to get to this ample reserves level. There's a good speech by my former colleague Chris Waller in Dallas, so if you want some bedtime reading, you can read that. But that was actually a very good sort of back of the envelope calculation about the balance sheet and all the pieces of the balance sheet. So I think that's a good place to start for those that want to understand current balance sheet policy. The mortgage-backed securities are going to take a long time to go off. I do think the Fed made a mistake in March, April of 2020. We went all in on mortgage-backed securities, thinking that the pandemic was going to harm the housing market, and we got 90 to 120 days in, and it went the other way. Demand for housing was way up. So, unfortunately, we added a lot of mortgage-backed securities over that 2-year period, but we're going to have to let that gradually go off.
Would you have voted for 50 this week?
No, I don't think so. So I thought it was a good decision because the Hawks could say that, okay, we only went 25 and we got optionality on the future moves, but the Doves got the 25 and probably 25 at October, and that's almost as good as getting 50 today. And you do get the optionality in there, so that's good.
When people talk about the institution you know so well, just based on what you've just said, do you think people underestimate just how persuasive you need to be on the committee, the degree of negotiations that do take place, about the kind of things you just described?
It's a big formal meeting, and people are very good at making their arguments, and they have the presidents have their own staffs. I mean, I love it. I think it's a great it's a great place to make decisions. I think also people have to understand that you're not talking so much about what you're going to do on the day. You're talking about what should our future path be over the next 6 months and over the next 2 years, but especially over the next 6 months, because you have to. It's a big committee, and you have to be basically on board with what you're going to do on that particular day.
You were very vocal about how you felt about the dot plot back in the day. Didn't like it. Put your dot at zero.
You can bring this up.
Okay.
Mention it as soon as you walked into the room.
It was so significant to see your dot always just there at zero.
Yeah.
Are you going to get rid of it? Would you get rid of it? I mean, what use does it
I
have?
think we can do better than we have on the dot plot. And at one point, I talked about dropping out completely. I did drop out of the long run dot part, but I think we could do something like former Chair Ben Bernanke outlined in the recent conference that the Fed had about the framework review, and he mocked up a quarterly report that could be put out, and that would put out a forecast. That's what other central banks do, and then members can talk relative to that forecast. They could say, well, no, I'm more optimistic about the economy, or I'm more pessimistic about inflation, or whatever. I think that would be closer to an international standard, and that's probably the direction this should go, because the dot plot has its problems.
I remember when you made that move at the time, and I can't believe it was about 10 years ago, which is just amazing how quickly time has flown. Jim, it's good to see you. Appreciate your transparency, and good luck with the process. Thank you, sir. Appreciate it.
Great to be here. Thank you.
Thank you very much. The former St. Louis Fed President, Jim Bullard there, and of course the candidate to be the next Fed chair. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The U.S. has vetoed a UN Security Council resolution demanding an immediate ceasefire in Gaza that was backed by all other members of the body. This is the 6th time the U.S. has vetoed a Gaza resolution since 2023 and underlines American and Israeli isolation over the war. U.S. Counselor Morgan Ortagus says the resolution failed to adequately condemn Hamas. Meanwhile, following the collapse of subprime auto lender Tricolor, its creditors nationwide are now racing to seize the company's remaining assets. The bankruptcy process will determine how much creditors will recover and which of them get paid first, with some already facing significant losses. And the FTC is suing Live Nation and its Ticketmaster subsidiary for not doing enough to curb the use of automated ticketing bots and large-scale resale operations. The suit claims Ticketmaster coordinated with brokers to buy concert tickets and sell them at a substantial markup, profiting from huge resale fees. Live Nation has not immediately commented. That's your Bloomberg Brief. John?
Thank you, Yahara. Appreciate it. Up next on the program, putting the pressure on the EU.
If the price of oil comes down, Putin's going to drop out. He's going to have no choice. He's going to drop out of that war. And when I found out that the European nations were buying oil from Russia, I was disappointed to see that.
That conversation is going to be next with Annmarie from London. I'm going off for assignment. Lisa's going to run things. Maybe I'll go for breakfast with Jim. We'll work something out.
Come on, don't go. You're leaving me? Sure.
From New York City this morning, good morning. Have a wonderful weekend. This is Bloomberg.
I'm going to get my color. Another day, another record. It seems like a broken record over the past number of months. What we see right now heading into the open, just about an hour, 2 hours away from the opening bell. And you can see a lift continue, although not really doing much, led by the NASDAQ. And really, Michael Hartnett putting it well, saying that there could be a Mag 7 bubble, but it will keep going because of the faith in it. Russell 2000 yesterday hit the highest level ever for the first time, a new record high for the first time since 2021 because of the move that we have seen in the rates picture today. Rates not doing much, taking back a little bit of the rally that we have seen with 2-year yields, 10-year yields and 30-year yields all up, but just marginally. We've been in this range. This question of just how far the Fed is willing to meet the market is really predicated on the idea of what the composition, as we were just talking with Jim Bullard, of the FOMC will be next year. I wanted just to point to the euro right now versus the dollar, a difference in the trend line. We had seen this rampant euro strengthening versus the dollar, a runaway train. And this would be the third session of euro weakening versus the dollar. Just to give you a sense of how relentless that dollar rally has been, that would be the longest streak since July 30th. And it goes to Geoff Yu's point that we were speaking about earlier this morning. Maybe we're going to start seeing some dollar strength actually heading into the end of this year. I'm alone. John ditched me. He's going out to breakfast with Jim Bullard. So I'm sitting here holding down the fort and under surveillance this morning, putting pressure on the EU.
If the price of oil comes down, Putin's going to drop out. He's going to have no choice. He's going to drop out of that war. And when I found out that the European nations were buying oil from Russia, I was disappointed to see that. And the prime minister was disappointed to see that. And it wasn't him. It was other countries. And you can't do that. You can't do that. You can't. That's not playing fair with the United States. And we can't have that.
Here's the latest. The EU looking to answer President Trump's call to curb trade with Russia. European leaders are looking to speed up plans to phase out Russian LNG purchases. Annmarie joins us now from London. Annmarie, I'm so glad that you're going to join me this morning. John ditched out. You've had a trip and been talking to a lot of European leaders. How serious are they this time around?
Well, it does seem like the president, he really is not stopping in terms of making sure that he tries to get the European Union more in line in ditching these Russian fossil fuels. Good morning to you, Lisa. And we saw this just 5 days ago. The president had a tweet out and he said, I'm willing to do more, but why should I do that if the European Union is still buying Russian fossil fuels? He said, I'm ready to go when you are, basically your move. And then he repeated that yesterday alongside the British Prime Minister Keir Starmer, who in some ways agreed with the president, saying it has been a challenge for Europe and they could do more. What we see now is Europe taking that on board, trying to accelerate their phase out of Russian LNG. You still have Russian LNG going to places like Spain, Belgium, France, and then, of course, there still are other fossil fuel supplies coming via a Turkish pipeline. When you look at the biggest importers of Russian fossil fuels, it's China, India, Turkey, the European Union, and South Korea. So this has been something the president has been putting pressure on Europe for. And we heard that from the Treasury Secretary as well in New York, sitting around the table with all of us, talking about the fact that when he brought this up at the G7 meeting in Canada, he said everyone at that moment looked down, wanted to see what kind of shoes they were wearing, and the room got very quiet.
Right now, Annmarie, I do want to bring you some headlines just crossing as we talk about this, that the EU is proposing banning Russian LNG a year earlier from January 2027. Also coming out with Ursula von der Leyen saying that she will come forward with a Russian asset proposal. This was potentially to repatriate some of the money and then use it for rebuilding Ukraine and such. And she also is calling on EU countries to endorse new sanctions. Can you talk a little bit, just based on your conversations, do you think this is truly a serious shift in the EU approach?
Absolutely, especially given the fact that these discussions have been going on for months. This push has been happening from Washington on Brussels for months. I would say since the president stepped into the Oval Office, he wants to see Europe do more. And we should also note, this is very similar to what we saw from Trump in the first administration. He really would put a lot of pressure and criticize then Chancellor Angela Merkel about the use of Nord Stream 2 and the building of this pipeline and why they were continuously reliant on Russian crude, but not spending enough when it comes to the collective defense of their budgets when it comes to NATO. And then remember, Lisa, when he talked about LNG, he would really talk about the fact that Europe should be buying more from the United States, and they have been. We need to give some context to the fact that we have seen Russian supplies to Europe drop sharply since Putin's full invasion of Ukraine. But they still are buying Russian fossil fuels, and that's Trump's point. And he's saying they should buy more American LNG. And I believe in his first time, he called it freedom molecules. So this is a similar tone that we saw from the president's first administration to the second. What we're hearing now, though, and the context now, is that there is a full invasion of Ukraine now. And what the president is saying is for the United States to get more involved, he wants to see their partners to do more as well.
Yeah, and we are seeing this. And just if you're just joining us now, the EU is proposing banning Russian LNG a year earlier, also coming out with proposal about credit card crackdowns from Russia, as well as more chemical, metal components and salts export bans from Russia. We'll bring you all those headlines. But just quickly, Annmarie, how much do you get a sense that this will be enough for the president to come through with some of the U.S. end of some of what's been discussed?
Well, I think that's a question that remains to be seen. This will certainly be taken as a very good first step, especially since you have the Treasury Secretary and the president really tried to get Europe to this point to do more. But the president said yesterday, and he was pretty blunt, he said, Putin let me down. He really let me down. So the president might be getting to a point where he's going to be more willing, especially if Europe's taking these steps to exert more pressure on Russia. We should note that Russia legislation in Congress is still working itself through, and this would also mean the United States taking a more forceful stance when it comes to Russia and its support of Ukraine. So potentially this is something that is going to be looked lightly on and welcomed in Washington right ahead of the UN General Assembly next week.
Annmarie, look forward to having you back in the seat. Thank you so much for that. And thank you for all the reporting this week from London. Coming up next hour, Nadia Lovell of UBS, Ken Hoexter of Bank of America Securities, Claudia Sahm of New Century Advisors, and Blake Gwinn of RBC Capital Markets. This is Bloomberg Surveillance.
The market does believe, as the Fed talked about yesterday, that we are approaching the trough of economic growth.
Now it's don't fight the Fed and don't fight the AI trade.
I'm not convinced that anybody's ready to give up on U.S. technology outperformance.
In stock markets and companies, the truth is if you're not growing, you're not going to be around for long.
You don't want to be underweight equities right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. John is off having breakfast with Jim Bullard. I am here in the studio as we do look to potentially close the week with yet more record highs. We did see overnight the Russell 2000 closing at a record for the first time since 2021. Across the board, you're seeing gains building on what we saw earlier this session. It was lower on the Russell 2000, but really the catch-up trade gaining steam. A question around how much this is fortified even without the participation of the rate story. We are seeing this morning a little bit of a bounce back in yields, the wrong type of up if you are looking for yields to gain value. And what you are seeing, though, is just this stability. And that is giving people a lot of confidence. This is a Fed willing to cut and look through some of the potential inflation coming through the pike. Right now, we're all trying to understand, even if this is a bubble, is it something that can keep going? Is this something that is the beginning of the cycle, the middle of the cycle, the end of the cycle, and does it matter? Dan Greenhaus of Solus Alternative Asset Management decided to come in. I begged him. I said, please, John's leaving me. I would love it if you would come in. Thank you so much for being here.
No worries. I'm a little nervous. I have to fill in for two people, but I think I'm up to the task.
I think you're up to the task.
Thank you.
What do you think about this idea of record high after record high and this concentration around the hopes and dreams of one story amid a slew of just dramatic uncertainty?
Well, my portfolio certainly loves it. I'll tell you that much. But so I'll say two things. First, with respect to the new high after new high being based on one idea, I've made this argument for some time. I think it is way too simplistic to reduce what's going on to just AI in terms of one idea. It's spider webbing throughout the entire market. It's not just NVIDIA. It's not just Broadcom. It's Vertiv. It's Eaton. It's, as the Wall Street Journal reports this morning, it's the hard disk drive companies. It has an effect throughout the entire market, and it's driving large, mid, and as we saw yesterday, small caps up and up and up. And the conversation you brought up, whether this is a bubble or not, it very well might be. In fact, I would go so far as to say it probably is. But the problem is, and using the 90s as your analogous reference point, people were talking about the 90s bull market being in a bubble in 1995, in 1996, in 1997, and say it with me, and 1998. And it kept going and it kept going. My problem with taking what's going on and comparing it to historical reference points is, to put it simply, every new high in the bull market should be bought except the last one. And all that you need to know as an investor is why is the last one the last one? And we have no indication yet that appears to be happening.
Yeah, so you just have to go to Back to the Future and get one of those time travel machines, and then you'll be just fine. I guess heading into this hour, a key question is how much can the trade story and renewed uncertainty really disable this idea of just keep buying stocks? And this phone call between Xi Jinping and President Trump, is that on your radar or don't you care?
Yeah, I mean, it is certainly on my radar, and we've talked about this in the past on the show. I think, generally speaking, the market is very sanguine right now about tariffs. Clearly, a large portion of the market thinks good. We know this is a complicated conversation, but we know the parameters of the complication. Exporters are going to bear some of it. Importers are going to bear some of the increased costs. Consumers are going to bear some of the increased costs. And the one issue that I've expressed repeatedly and stays with me is when you listen to what companies tell me during earnings season, I know that conference calls are marketing documents and marketing events, but still they're telling you what's going on in the world. A huge number of consumer companies have talked about more tariff increases to come over the next, call it 6-12 months, let's say. And so the investing community is fond of talking about tariffs as a one-time increase in the price level. An idea theoretically I agree with. However, that one-time increase looks like it might be one time here, one time there, one time there, one time there. And I'm not positive 6 and 9 months from now that we have a firm handle on what that's going to look like.
Well, we've got a lot to unpack, and luckily we have you on set the entire hour
luckily
to
for everyone.
Enjoy. Absolutely. And right now we begin with this hour with stocks trading near record highs. Nadia Lovell of UBS writing this: we maintain an optimistic medium-term view and consider pullbacks as opportunities to invest, particularly in areas of structural growth. Nadia joins us now. You've been listening to this, going back and forth. Do you agree that this is sort of a structural story you can't avoid to be part of, this idea of whether it's AI, whether it's the Fed easing, or whether it's just the idea that consumers keep on spending?
Yeah, we agree with Dan on many of those points. And it's not just an AI story. And you are seeing that expansion out of it. But also, it's also an overall electrification story. Now, is AI contributing to that electrification growth? Absolutely. But the fact that we also have this push to reshore manufacturing, we also have just the overall increase of population growth and what that means for electrical demand. So when we look at the picture, not only AI, but also overall electrification, when you think about it, there's probably need, just in the U.S. alone, 100 to 200 gigawatts that's needed over the next decade. And so we think that that's going to be a $3 trillion revenue opportunity to bring all the grids up to par over the next 5 to 6 years globally. And so that's hitting utilities, that's hitting industrials. So it's beyond the one single stocks that we knew a couple of years ago, and it's now a lot more.
So to this point, and you're both talking about the same thing, these sort of themes and the percolation into other industries, I just wonder how much that edifies the idea of rotation into small caps, the other 493, including ones that aren't necessarily included in that, or do you think that's a head fake that just is a sentiment shift on a couple of traders and will revert back?
You know, small cap has had a few head fakes. We're finally seeing that all-time high after several years. And in order to keep that momentum going, we know that we need to see the earnings growth follow through. And that is yet to be seen. We know that small cap is highly correlated also with PMIs. You know, manufacturing PMIs has sort of been in the doldrum. We've seen a pickup in new orders, finally back above 50. But, you know, what I'm hearing from our industrial analysts, because they've been visiting with many companies these last couple of weeks, is that some of those short cycle industrials are finally admitting that, you know, the boom that they've seen in the last few months is tied to front running ahead of tariffs and inventory build. And so it's not certain that we'll see this continued durability in new orders and a full recovery in PMIs near terms. And so we do question the durability of that small cap trade. Could it look better in 2026 when there's likely to be more of a sustained pickup in manufacturing? Possibly. But near term, we're a little cautious of it and understand why people are pulling out that lower rate playbook. But we need more.
We're invested in a couple of small and mid-cap companies, and they've lately, in conjunction with the broader market, done very well. But they've been doing well fundamentally for a while. And the debate we've had internally about some of these smaller companies is an extension of the David Einhorn argument, where he has argued in the past, as a deep value investor, which often means going down in market cap, you could rely on the market coming around to your viewpoint, and the stock or the credit in which you were investing could appreciate as the market realized what you already knew. And in an era of passive investment, that's become much more difficult. And so we've seen 2 or 3 companies that we own that are doing very well fundamentally, and the stock hasn't done very well until recently as the broader market has appreciated. And I think so the first point I want to make is there's a larger conversation here about the influx of passive AUM into the market, which is now more than half of ETF and mutual fund AUM, what effect that has on the ability of small caps in a secular sense to continue to perform along with medium and large. But I would also add, to this point about, you know, Nadia mentioned it's more than AI, a point I agree with. I'm looking at the best performers in the S&P 1500, which is small, mid, and large. Who are the best ones this year? There's not a Mag 7 on the leader list right now. It's HOOD. It's AU, Anglo Gold Ashanti. AU, as we all know, is the periodic table symbol for gold. My science teacher once told me, AU, give me back my gold watch. I've never forgotten it. That's how you know it's gold. It's Roblox, Palantir, I guess. It's Mr. Cooper and Rocket. There's a large, I only named a couple, but there's a lot of companies doing very well here that are not at all, even indirectly, tied to the AI story. So I agree with you entirely. There's a lot going on.
Yeah, okay.
No, I'm just thinking to myself, how do you put together then what to pay attention to? You know, the idea of, okay, even if it's a bubble, you can keep buying into it. How do you know, Nadia, what to focus on that could potentially be a risk, given that we're all kind of sick of worrying?
You know, we don't think that it's a bubble. You know, it's always hard to determine whether you're in a bubble. But, you know, we look for signposts. And yes, you can point to valuations, but we're still not at, at record levels. So we don't think that, you know, there's not an excessive amount of liquidity and all of these other factors as you look for a bubble. So what are we paying attention from a risk standpoint? It does go back to this AI related trade, because reality is, like last year, we remember people became hyper focused on return on invested capital. That seemed to have gone through the window. out the window this year. And that's because you are starting to see some signs of it. But when does the market return to focus on that? Could that happen next year? Possibly. Right now, the investments are still happening. You're seeing a little bit of pickup in terms of impact on advertising, even in China, impact on gaming. But I think that at some point, the market is going to want to see more. And the question is, when does that happen? Is that a second half 2026 story? And if that is, right, remember now, maybe we have a Fed that is cutting enough to re-stimulate the economy, and the small cap gets even more of a sustainable bill. So we think that this healthy broadening out is needed to sustainability of an overall bull market, and it just shouldn't just rely on the AI trade.
Just real quick here, does it make you more excited or less excited to see the government taking a stake in some of the big tech companies?
Nadia, be careful.
Be careful. When you see it, sometimes when you see it, and this is not, I'm not talking about a single stock view. Sometimes when you see a good investment, and we think that U.S. tech companies are a good investment because of the earnings growth that we're seeing, why not the government too? Our government is recognizing the continuing innovation that our broader technology and companies are seeing.
Spoken like a true politician. Nadia Lovell of UBS Global Wealth Management, thank you so much.
Maybe I'll run for president.
Yeah, exactly. Well, I'm just saying, honestly, it's a fair question given what we've seen with Intel.
Yeah, listen, for many years, certainly right-leaning people, but people in general would have said the government probably shouldn't be taking stakes in private sector industries. I understand the president and the administration's impetus here. I understand what they're trying to do. My gut, my fiber, how I learned and how I've experienced life tells me this is ultimately not going to be a good idea. But I do understand saying, we need a functioning this, we need a thriving that, and the government's going to help do that. And whether it's tax incentives or direct investment, the government's been doing this for quite some time, and this is just a different variance of that.
I think that Nadia was more politically savvy. I'm just saying. No, I'm kidding.
I'm not running.
That was very good.
When I run for mayor, we'll see.
You're going to run for vice president.
All right, right now, let's get you an update on stories elsewhere this morning. And Nadia, thank you so much. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Trump is gearing up for a phone call with Chinese President Xi Jinping. The two are set to speak at 9 a.m. Eastern. On the agenda, the fate of TikTok and potentially easing trade tensions between the world's biggest economies. The call may lead to an in-person meeting between the two before the end of the year. Meanwhile, former Vice President Kamala Harris says Pete Buttigieg was her first choice as a running mate when she ran against President Trump in 2024. In an excerpt from her book, 107 Days, which will be published Tuesday, she says Buttigieg would have been the ideal partner if she were a straight white man. And Apple is releasing its new iPhone designs today, including the iPhone 17 Pro, Pro Max, and iPhone Air, as well as new Apple Watch and AirPod models. Early sales across Asia showed strong demand for the Pro models, with wait times of up to 4 weeks in some countries, while Japan had next-day delivery available. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I do want to bring this to you. CCTV, the Chinese broadcaster, is reporting that Xi and Trump have been holding that phone call, that it is ongoing. We haven't gotten confirmation yet from the White House. We will bring you any additional details as we get them. Up next, we've got the morning calls, plus Ken Hoexter of Bank of America Securities, with FedEx rising despite a warning on tariffs. That's an intimately tied story to the discussion around China. That's coming up next. This is Bloomberg Surveillance.
The committee's also spooked a little bit by last year, because last year the data looked weak but then turned around abruptly. It's hard to say exactly how high the bar is. That's a judgment call that'll have to be made by members of the committee.
That was former St. Louis Fed President Jim Bullard, who also is a potential candidate to be the next Fed chair, speaking with us just moments ago. A question of how much the Fed is backstopping this market right now. Futures trading with a lift after earlier being basically flat, building on the gains that we already have seen. The Russell 2000 really leading the charge over the past few weeks. This morning lagging behind just a touch, but this real sense that we can keep building on this because of the AI story, because of the Fed backstop, because consumers keep spending. Time now for the morning calls. First up, Citi downgrading Intel to sell, pointing to the chip maker's rich value. Those shares lower by almost 1%. Next up, Baird upgrading Tesla to outperform, saying the EV maker is increasingly viewed as the leader in physical AI. Those shares getting a little bit of a lift, up 0.9%. And finally, BMO downgrading UPS to market perform, noting the company is not seeing a recovery in demand amid macro headwinds. Sticking with shipping, FedEx is rising in the pre-market following better than expected earnings. Ken Hoexter of Bank of America Securities raising the price target to $244, noting momentum in structural cost takeout. Ken joins us now. Ken, thank you so much for being with us. And I'm glad that we're starting with that point, because when I was looking at the earnings yesterday, the fact that they reaffirmed their guidance, they talked about strength despite the $1 billion of headwinds or costs tied to the tariffs. Highlights to me, how much are they using this as an opportunity to shed costs, to cut staff, rather than simply something they have to do?
Well, first of all, good morning. Thanks for having me. Certainly they are moving to cut costs. This is something they've been very focused on when you think about the blending of express and ground, and they're trying to get ready to spin off their freight segment early next year. So they're definitely working on costs, but they're talking about $1 billion of headwind as well to offset that $1 billion of costs. So while they did set an earnings outlook that was a little bit higher than the street, if you look at the next 3 quarters, it was actually in line. So the beat this quarter does not follow through. It looks like you're just kind of staying in line with general outlooks for the rest of the year.
How much, Ken, is this company still a bellwether for the economy versus a very specific kind of industry that now is affected by all sorts of international discussions and other factors?
Yeah, very much so, right? I mean, with the elimination of the de minimis, you've got things that are affecting them. You've got Amazon now as a major player, so it's not just looking at the economy. It's how much is Amazon coming in and taking volumes away from FedEx and UPS or the post office, right? We saw a big post office contract switch away from FedEx and go over to UPS. So you've got business swapping back and forth. I'd say, these businesses, though, at the end of the day, are very economically concurrent when you look at the stock performance and where they need those volumes. And given we've been in this freight recession for about 3.5 years, the stocks have felt that and the volumes. But we've also been in a structurally changed market where, with the advent of emails and legal documents being able to be signed online, you don't have those regular movement of packages. So it's shifted from a B2B market more toward a B2C. And that has really hurt the economics of the business, because where you used to stop and deliver about 4 packages per average stop, now you do about just over 1 package per stop, and that changes your cost structure. And so we've seen a very significant change in the cost structure from the air freight companies, and to what you're talking about on the top line growth, how economically dependent they are.
Ken, correct me if I'm wrong, but domestic volumes were up 4.5%, which I think was pretty good. And going forward, they have this contract with Amazon, which I think you would agree is probably going to lead to an increase in those volumes. So to the point about being a domestic bellwether, as I look ahead, as that Amazon contract comes online, isn't it going to be telling me more about those specific volumes rather than any broader economic indications?
Oh, absolutely. Absolutely agree with that. The spike you're going to see, again, they targeted their outlook for 4 to 6% revenue growth. Consensus was looking for about 1%. So that means you're going to grow revenues about $3.5 to $5 billion above expectations, above the $1 billion prior target. So all of that is Amazon. And the interesting thing there is, despite that additional revenue, they're still actually looking for earnings to be down slightly year on year. So that would tell you what kind of revenues are you bringing on board and what additional costs are now going in the network that are going to lead earnings to be down slightly year on year. So definitely trying to backfill with some additional volumes from the lost postal contract, the loss of de minimis, which has been very significant, but trying to fill that in with other revenues. But you can see with profits going down, it's still a battle, and agree that that's not very economically dependent. It's on what other contracts are coming up. But they did win some core business, right? We heard Best Buy and some other kind of major customers have switched over to the network, some from their competitor, and that's great for them. But you're right, as far as the big picture, when you talk about those overall volume growth, it's going to be things like the Amazon contract win or other non-economic sensitive business.
Ken Hoexter of Bank of America Securities, thank you so much for jumping on with us this morning, and have a wonderful weekend. Turning now to Washington, D.C., Chinese state media reporting the call between President Trump and China's Xi Jinping is underway. Bloomberg's Tyler Kendall joins us now. Tyler, what do we know about the call?
Yeah, Lisa, well, you said this. This is according to Chinese state media that this call started around 8 a.m. Eastern. Of course, our understanding had been that it would start at 9 a.m. Eastern, so it appears to be off to an earlier start. We're still waiting for the White House to confirm the details here. Of course, this marks the first call between the two leaders that is publicly known since June, since President Trump took office. Really only the second time that they have had these discussions. Importantly, coming to the forefront of the conversations today really does appear to be a potential framework agreement when it comes to TikTok. Of course, we're still waiting for a lot of key details to emerge about that potential deal, but Bloomberg News has been reporting that it's very likely going to be structured with a group of new outside U.S. investors. Names like Oracle are included, combined with some existing investors, and then, of course, ByteDance will still, according to our reporting, hold a share, but that will likely be below 20%, all in a bid to make sure that it passes muster with Congress's national security law. Another big question here is what the algorithm is end up going to look like, whether or not ByteDance could be licensing that to the U.S. It's going to be a critical question here as well when it comes to addressing those national security concerns. And Lisa, yesterday we heard President Trump both in the UK sort of dodge a question there when it came to what the future of the algorithm is going to look like. And then later in his interview with Fox News, ultimately saying that a lot on this deal rides with what Chinese President Xi Jinping is going to say when they get on the phone.
Tyler Kendall, thank you so much for being with us, and I'm sure we're going to catch up with you throughout the day as we get under updates on this call. Dan, what do you think of this? I mean, how much do you track this as an investor from a day-to-day kind of perspective? The idea of what new uncertainties could be built into any particular trade relationship?
Well, I mean, you have to pay attention to this. I mean, obviously, I don't want to say you invest by tweet these days, but you certainly need
Truth Social.
Truth, yes, or whatever it's called on Truth Social. But you do need to pay attention. This is obviously a humongous geopolitical story. And I would also add, it's also working in the sense that in 2018, we imported like $540 billion worth of goods from China. Last year, it was $440 billion worth of goods. Now, some of that has just being rerouted through Vietnam and other countries, but there is a realignment going on here. And so there are companies, the shoe companies, the apparel companies, et cetera, they're all directly related to this conversation. So you obviously have to pay attention to it.
Does it make some of these companies difficult to invest in, to understand some of their profitability forecasts, given the fact that things like fast fashion were predicated on the idea of being able to make things cheaply in places like China, Vietnam, Thailand? As
a general rule, anytime the government's involved in an industry or a sector, it makes it a little more difficult because you're dealing with not specifically non-profit motive actors. And so, yes, by definition, it's a little more difficult, but not impossible. I mean, that's our job as investors, to wrestle with anything external or internal.
Wrestling is the Fed and trying to understand exactly, how did you like that transition?
Sure.
Wrestling how to gauge just how much prices were going to increase and what potential appetite there was on the part of consumers to absorb that. Coming up, Claudia Sahm of New Century Advisors as we look through that debate. Plus, Yahaira Anand on your movers. That is coming up next. This is Bloomberg. One hour from the cash open, and we can see equities turning up as the session grows older. Futures higher across the board, even the Russell 2000 after hitting
its first record high since 2021, currently up 0.2%, building on those gains over the past half hour. NASDAQ also up about 0.2% alongside the S&P 500. Let's get those morning movers right now. Yahira Anand has that for you. Yahira, what's going on?
Hi, Lisa. We start with FedEx shaking off any worries around President Trump's tariffs. Shares are rising 0.7%. And I wanted to add UPS to this because it is also rising 0.4%. They were both up much higher earlier. But sticking with FedEx, it beat on both the top and bottom lines and reinstating its outlook. It's saying that it expects growth of 4 to 6% next year, much higher than the 1% that analysts on Wall Street were expecting. And moving on to another company that reported earnings yesterday, Lennar shares are falling 3%. That is after profit took another hit at the home builder, falling for the fourth straight quarter as it continues to offer big incentives to get buyers into their homes. And on top of that, its forecast for new orders also came in light amid still elevated mortgage rates. And we end on the publisher Scholastic. Shares are plunging down more than 10% after posting a wider than expected loss in the first quarter, and call it the Doge effect, because what Scholastic says is schools are pulling back on spending due to uncertainty around federal and state funding, and that sent its revenue in that unit down 28%, a big contributor to that wider than expected loss. Lisa?
Thank you so much, Yahira. We just want to bring this to you. The White House has confirmed that the Trump-Xi phone call did start. It started at 8 a.m. Eastern time, so it's been going on for about 32 minutes now, and we'll bring you any further headlines about any results from that phone call. Initially, it was published by state media in China, now confirmed by the White House. Let's turn to the Fed as the Wall Street digests the first interest rate cut of the year, as well as a dot plot showing a wide range of views. Bloomberg's Michael McKee joins us now. And Mike, there has been a confusion in markets, an expectation that if the Fed did not deliver what the market was expecting, there would be a sell-off. The Fed did not deliver as much as the market was expecting, and markets did not sell off. How much is there a sense that this market has moved on from a Chair Powell at the helm of the Federal Reserve?
I don't know if it's so much that they've moved on from a Chair Powell. I think it may have something to do with the way Powell was able to frame it and get people to believe that the Fed is inclined to cut rates, but is not promising to cut rates, no matter what the dot plot seems to suggest. They're going to watch what happens in the economy, to the data, and to companies, and to earnings, and to TikTok and AI going forward. You look at the calendar coming up, and we have a lot of stuff to keep an eye on over the next couple of months. Anytime we could get a ruling from the Supreme Court on Lisa Cook, and that will have a big impact on markets, no doubt. Next Tuesday, Jay Powell speaks again and will give us his outlook for the economy. The September jobs report is coming up, and there's a but to that. If they shut the government down on October 1st, we might not get the jobs report on the 3rd of October. The 15th of October is the September CPI. That'll obviously be important. And then October 29th is the next Fed meeting, not just the jobs report and CPI, but we'll get a lot of data between now and then that will give the Fed a better idea. And then you've got the long run to try to figure out. The Fed looking at the Cook case fallout, whatever it is. She's either on the Fed, or if she's out as the president, trying to nominate somebody else. The Fed chair nomination, which may come sometime in October, December timeframe period. You talked to Jim Bullard this morning about that. Fed meeting on December 10th. There is a cut forecast for that by the markets. And Stephen Myron's term ends in theory on January 31st. But if the president doesn't appoint anybody else, he could stay on as long as they don't have anybody else. And then, of course, at the end of February, the Fed president's deadline. They have to decide whether to renew all their contracts. So there's a lot to figure out here. And I think that if you're betting on Fed funds futures for any particular meeting, you may be disappointed.
Michael McKee, thank you so much. Dan Greenhaus here was alongside me this morning. I'm just wondering how much you're discounting what the Fed says at this point, looking to a more dovish 2026 just by virtue of some of the personnel shifts.
Yeah, we've known this for a while, that the Fed was going to be shifting in this direction. But in their defense, I think the press in general makes a little too much out of Trump getting control of the Fed. U.S. presidents get to appoint people to the Federal Reserve Board. And sometimes a president gets a majority of the board. 99.9% of the time, we've never thought about, and the press has never presented it as if that's a problem. Obviously, there's a uniqueness to the current situation in terms of how vocal the current president is in terms of wanting lower interest rates. But conceptually, was Lael Brainerd not a quote-unquote a big D Democrat? Did Arthur Burns not spend the entirety of the 70s begging Nixon to play golf and wanted to lower interest rates, thinking that would increase his odds of getting to play golf with the president? So I don't think in that sense there's too much of a uniqueness to the current moment. And I would add, the jobs market is slowing down. And so if you're the Federal Reserve, can you tolerate 3% inflation? Probably. Can you tolerate job losses? Absolutely not.
Which is something that I think the market very much picked up on. Let's stay on this conversation. Claudia Sahm of New Century Advisors rating this. Its dual mandate of maximum employment and price stability is in tension. Cutting rates to reduce the downside risks to employment increases the upside risks to inflation. Claudia joins us now. Claudia, so great to see you. And this is really the point that we were trying to wrap our heads around. How much does an emphasis on growth, a prioritization of the employment market, increase the risks of inflation in a way that isn't fully appreciated?
Right. Well, I think, Powell is telling us the Fed appreciates this. There is a tension. Inflation is elevated. It's been elevated for more than 4 years, and it's probably going to go a little bit higher before it starts moving lower. Cutting rates is not going to help on the inflation side. But I think, to your point, it's about which one is the more acute problem. If we go into a recession, which is not the Fed's baseline, that is not my baseline, then we have a big problem. And so that's what the Fed is reacting to. If inflation gets stuck, yes, that is a problem, and they will have to come back to that. And it may, cutting now may make that problem be real in the future, but it's not as acute. So it's this balance of risk that they're trying to sort out right now.
And it's a balance of risks that seems to have allowed inflation to be above their 2% mandate for more than 4 years and potentially for 6 years based on their forecast going forward. Is this a Fed that might say verbally 2%, but might mean 3%?
It's certainly a Fed that has shown its willingness to give it time, right? So the target is 2%, but the target doesn't say 2% next month, next year, right? They give themselves some runway to get there. And the trade-off has been, allowing the labor market to be more resilient. I mean, coming out of the surge of inflation in 2021 and 2022, the Fed could have gotten that down to 2% really fast, but we would have had to have a recession, a severe one, to do that. And they chose not to, right? So, there's no free lunch here, right? The goals are in tension, and they still continue to navigate this. And I think if you really focus on, and they say it in their framework, they look at how far employment or inflation is away from the goal and for how long it's going to be away from the goal. And so I think they made the right decision at this moment, thinking about the employment data has been pretty soft and disconcerting, but keeping an eye on inflation at the same time.
Claudia, I think the point you made there about they could have brought inflation back to target more quickly, but chose not to. As investors, I think your performance was directly related to how quickly you realized that reality, that they simply were not willing to do what was necessary to get inflation back to target. But I do want to ask you, just to pivot a little bit off of what you were saying and what we're discussing here with inflation, as point blankly as I can, are tariffs inflation?
Tariffs are going to increase prices, right? So there is a period, inflation is an increase in prices. So there is a period where it appears likely that they are putting upward pressure, and it's not just relative price changes. But I agree with the sentiment that it is a one-time price level adjustment, right? So it's not inflationary in the sense of creating inflation forever, but I do get very concerned. And I frankly think the Fed may be downplaying this risk somewhat at this point, that as you've had inflation higher, closer to 3% for some time, people are just going to build that in. Like, not everybody's running a model of tariff effects and this and that and the Fed independent, like they just see inflation. And then when they have to plan for the future, a business or a family, they just kind of use what they've seen recently. So I do worry there's this creep of we just start building in the higher inflation, and then that's where we get stuck.
I agree with you conceptually. Obviously, we view things through the prism of inflation expectations, and you don't want consumers to start adjusting behavior in that way. But what you just articulated there was a worry that consumers would start thinking about it this way. But isn't it fair to say that the worry about future inflation expectations should be treated subordinate to the reality of the slowdown in the private sector job market?
But I mean, you need to think of the price setting process and the way businesses make decisions, the way they, forecast their decisions is an important one to make. So I don't want to downplay the expectations. I will say there's another piece thinking about inflation dynamics going forward, which is really the question, like, what is this doing to inflation 2 years from now, 3 years from now, is to think about this. These tariffs are part of a major reshuffling of global trade. And we have benefited. One of the pull down on inflation that we've seen for many years in the United States is through good imported goods. We have trade, we have innovation. Like, that's actually been something that helps hold inflation down. And even if it's not like a big effect, losing that actually could give some lift to inflation over time. So it's not just about what's in people's heads. Like, we really are reshuffling the deck in terms of the way trade is done and the way the goods come into the country.
And this is one reason why some people are saying it's so hard to get a handle on exactly what the new neutral rate is and how much higher inflation just naturally will be in the economy. Claudia, you've researched the labor market for a very long time, and I wonder whether it makes sense to run the economy hot, to run the labor market hot at a time of dramatic transition in terms of the AI shifts, how quickly that's changing some of the job roles, the necessity for companies to actually invest in reskilling a lot of people. Do you think that this is sort of a new priority that necessitates a faster pace of growth?
It's a difficult dynamic to make. I mean, running the economy hot when we already have inflation that is elevated, I mean, that's really a risky scenario. And I will say, just seeing like the Michigan survey, household surveys coming out again, people are very clear. Like, when they talk about what's wrong, like, they're pretty pessimistic. Higher prices is still a big issue. So inflation has come down a lot, but it accumulates over time. So there's not an easy answer to that question. And a lot of it is gauging as to exactly how hot we're running it. Like, I think you can make an argument on the margin for maybe, going on the side of let's let employment run, let's let investment run. But you have to be careful, because some of the discussions about let's have a federal funds rate of, say, 1%, that's not an on the margin discussion. That's like a big overturning of like how hot we're willing to go. And I think there we need to be very careful, because inflation is not something that people handle well.
Claudia Sahm of New Century Advisors, wonderful to get your thoughts. Thank you so much for joining us, as always. Dan, you looked pretty excited there. Or what's going on?
Well, she's talking about how consumers are still upset about inflation, and I think that's obviously correct. Any number of surveys bear that out. I think where I disagree, or where I need further clarity, and I think investors in general do, is, are they upset about the rate of inflation, or are they upset at the level of inflation? And I mean, if you go and you fill up your Amazon Fresh or your Walmart grocery basket with the same basket that you bought 3 years ago, it's obviously going to be 20, 25, 30% higher, whatever the number is. That's the problem for consumers. Not that prices are going up 3% instead of 2%, although I don't mean to downplay that to some degree. It's the cumulative increase that's been experienced these last couple of years, and there's no going back on that. You can we can get 3 to 2%, but consumers who are upset about that cumulative increase, we're not solving that problem.
And that's the reason why it's an increasingly political issue, even if the pace of inflation was going down.
Right.
That's the reason why people were feeling bad about it. We're going to pick up on that conversation in just a bit. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. U.S. law enforcement is building a profile on suspected Charlie Kirk shooter Tyler Robinson. Sources say the Secret Service has joined the investigation into the shooting, even though Kirk wasn't under the agency's protection. They say agents are studying Robinson's behavior and online activity, including his use of President Trump's name on an online video game platform. Meanwhile, Senator Josh Hawley is demanding information from OpenAI on the risks ChatGPT poses to children and teenagers. In a letter to OpenAI CEO Sam Altman, the Republican lawmaker said the company has until October 17 to respond to his list of questions. The letter follows a hearing this week where parents testified about the alleged dangers of ChatGPT on young people. And Madonna is getting ready to release her first album in 7 years. The Queen of Pop announced a new dance album that she's referring to as a long-awaited follow-up to her record Confessions on the Dance Floor. For the project, Madonna reunited with Warner Brothers, the label where she started her career. That's your Bloomberg Brief. Lisa?
Yahira, thank you so much. You've got to admire that stamina. Up next, setting you up for the day ahead, plus Blake Gwinn of RBC Capital Markets as we hash out the debate about inflation and its ramifications for the bond market. This is Bloomberg Surveillance.
I thought the Fed's decision was a good one. This looks like a sequence of 3 moves in a row through the end of the year. Non-farm payrolls is kind of the key number for the Fed, so I think that made them a little bit nervous. I think that tilted things toward a little bit more dovish policy.
That was former St. Louis Fed President Jim Bullard, who was on the show with us earlier this morning, talking after a discussion about potentially being the next Fed chair. Happening right now, President Trump and Chinese President Xi Jinping speaking on the phone. The phone call started at 8 a.m. Eastern time. Bloomberg's Tyler Kendall joins us now from the White House. Tyler?
Yeah, hey, Lisa, this is according to Chinese state media. The phone call between the two leaders appearing to get off to an earlier start than expected. This marks only the second known phone call between President Trump and Chinese President Xi Jinping since President Trump took office. And really coming to the forefront of the conversation does appear to be the future of a potential deal on TikTok. We are still waiting to learn some of these finalized details of a potential agreement, though yesterday in an interview, President Trump really said that a lot of it is going to be dependent on how his phone call with Xi goes today. This phone call is widely seen as setting up a potential face-to-face meeting between the two leaders. We're eyeing a potential summit between them next month at the APEC summit in South Korea. And that's where perhaps we'll see a little bit more of these tangible deliverables when it comes to what sort of progress is being made in the trade talks between the two countries. Because as you well know, there is a lot on the table, and it doesn't appear that it's all going to get settled today. Of course, everything from the mounting pressure Beijing has been putting on Nvidia to the U.S. pressuring China to scale back on its imports of Russian energy supplies, even potentially purchases of Boeing aircrafts. Lisa, these are all sort of things that we're going to be looking out for later.
Tyler Kendall, great work as always. Thank you so much and have a wonderful weekend. Turning now to rates, the picture behind the scenes as we've watched all of this play out. Blake Gwinn of RBC writing this: there's no particular urgency or drive to get rates meaningfully lower. We still think the Fed is going to pause or skip October or December. Jim Bullard disagrees with you. Blake joins us now. I'm actually very excited to hear how you think that they're going to push back against what seems to be a groundswell of support for rate cuts despite inflation being higher and despite the fact that some are saying that growth is reaccelerating.
I don't necessarily think they're going to have to. I think the data might do it for them. So we saw this kind of play out last year where we had weaker data in the summer, then it started to kind of bounce back into Q4. And I think we could see something similar play out this year where that labor data and some of the downside weakness that they were concerned about, that kind of moderates a little bit. And you still have this inflation problem that they're dealing with. And let's not forget that the committee was pretty split. If you look at those dots for 2025, you still had nearly half of the committee that only saw one more cut this year. So I don't think it's a big lift to get to that point where they're skipping a meeting.
Do you think the market just heard what it's wanted to hear this week and didn't actually pay attention to the dots, didn't actually pay attention to the committee, just saw what Stephen Myron did and said, we're going to go with that because ultimately that is probably closer to what next year will look like?
I mean, I know we use this analogy a lot, but this truly was one of those kind of Rorschach test type of dot plots. I mean, you could take a lot of different messaging from it, partially because you did have the split in the committee, so there was something there if you wanted to lean more in the hawkish direction, as I tend to do. You had those dots who only saw one more cut this year, who saw a skip. For those leaning more dovish, then you had the core of the committee, and obviously the mirror and dot was significantly lower than that. The economic forecasts were very little changed, so it doesn't really look like from the June meeting the Fed's outlook has really shifted. I mean, this was entirely about the balance of risks.
Let me just go on record, because I know you discussed this with Jim Bullard earlier. Let me go on record as saying the dot plot should be done away with. I mean, every single meeting, every single press conference, he has to spend some time telling you, don't pay attention to something that we give you to pay attention to. It's ridiculous. They should do away with it. But I mean, getting back to the 1 versus 2 cuts, I mean, we talk about this a lot in the context of equity investment, and you have a lot of equity investors and analysts and strategists that'll come on here and say 1 rate cut doesn't matter, 2 rate cuts doesn't matter, the path is what matters. But you're in the rates market where there are investors putting billions of dollars to work on whether you get 1 or 2 rate cuts. And if I look at the 2-year, it's telling me 2 rate cuts are coming. So I would ask you, is that not a fair analysis of what's going on, viewed that way? And then secondly, when you look into next year, what do you guys think is the right path for policy? Not necessarily what they're going to do, but maybe when you guys discuss behind the scenes, what should they do?
Well, first of all, I'd say don't come after my livelihood. What would we write about if we didn't have the dots to talk about all this time?
You'd find something else.
That fills a lot of paper. So, but I do agree. The dots are very tough. The Fed constantly finds themselves having to kind of
explain why they don't matter. Yep.
But I do think one thing that's interesting, even with a lot of the conversations I had into this meeting about people who thought they should cut 50, people who thought they should skip, everybody kind of agrees that the terminal level next year is, roughly around 3%. That's what we're kind of pricing into markets. We've priced in a bit of a band around that. But whether you think they get there more quickly or they get there slowly, everybody's kind of seeing the same endpoint right now. And I think as long as that's kind of locked, I mean, that's what really drives financial conditions.
Yeah.
So, whether they go, 2 more times this year, whether they go 1 more time this year, if they end up at the same place next year, that's what's being priced into, corporate interest rates. It's what's being priced into mortgage rates. That's what kind of matters more for the real economy. So that gets into a very interesting territory because, and Powell brought this up a little bit. He said, one cut's not really going to, be the difference between a recession or, runaway inflation. But look at what's priced into the path. It's a bit of a tricky spot for him to be in because now you're kind of saying, well, do you have to cut along that path to just stay neutral? If that's what's being priced into the market, does he have to follow what's priced into markets in order not to have the economy actually get tighter?
The market's reaction is the policy.
Exactly, yeah.
So we just have about a minute left. I'm going to do a rapid fire round because why not? Do you think that the yield curve is going to steepen or flatten for the remainder of the year, considering that the flattening we've seen recently flies in the face of what we've seen recently? Blake?
I'm pretty neutral to year end, but I do think we have not seen the steepest in the curve. I do think it can get steeper.
What do you think?
If the 2 years is going to keep coming down, and again, it's at 360 or whatever, if it's going to come down and the 10-year is stuck, for lack of a better word, because of growth and inflation realities, then it's probably going to steepen 75 basis points.
I mean, almost all the steepening we've had up to this point is what we would consider bullish steepening. It's happened because the front end of the yield curve is moving lower, which is interesting because I think earlier this year, a lot of the concern or a lot of the positioning and steepening was really about the back end moving higher. And we haven't seen that at all. It's really been all about the Fed moving down. So I certainly think you could see a bit more of that pressure, but also once we get into a full cutting cycle maybe next year, then you see that front end price in a little bit more.
Blake Gwinn of RBC Capital Markets, thank you so much. Dan Greenhaus, thank you so much. A big thank you. This was fun. Great to have you here. Of Solus Alternative Asset Management. He decided to hang out with me this hour, and I'm grateful for that. Coming up on Monday, don't miss this. Andrew Sheets of Morgan Stanley, former White House trade official Kate Kalukowicz, Henrietta Trey's of Veda Partners, and Kelsey Barrow of JP Morgan Asset Management. We will parse through any results from that phone call, which has been ongoing between Xi Jinping and Donald Trump, starting at 8 a.m. Eastern. This was Bloomberg Surveillance.